That 5% of GDP defence and associated spending. We'll watch that. Mining stocks in focus. That could weigh on London a little bit as we see, for example, iron ore prices just a little bit weaker this morning. And bank stocks in focus. A deadline approaching in Spanish bank M&A. And we also see job losses at HSBC. A number of reasons, guys, to watch that sector.
We're going to watch that very, very carefully. So basically, Eurostoxx futures going into the session here in Europe, that's the European side of things, are unchanged. So I don't think you're going to see much action at the get-go of trade this morning when it comes to the markets that were open yesterday. The London market might be a little bit different. It has to play catch-up. To what extent it does that remains to be seen, but we're up by around 0.2% currently on the FTSE 100. But the Stoxx 600 comes through absolutely flat as anticipated. It's already, to a large extent, priced in the move, the recovery move that we saw versus Friday. So you're getting no action there, but the FTSE 100 still has to play that catch-up trade, as Critty was indicating. CAC's down a little bit, 0.1%. The IBEX is down by 0.2%. The DAX is up by 0.1%. Kind of all netting out basically to a very flat open for Europe, excluding the FTSE 100, which is up by, let's call it, circa 0.8%. Critty, sectors?
We're not seeing a real kind of sectoral trade here. I'm just looking at the movers that were the outperformers yesterday, at least in the European trade, are the underperformers today. And yet you are seeing broad gains, but again, marginal ones. So I wouldn't read into this green on the screen in terms of kind of an overarching positivity or bullishness, Anna. But I think it is notable that a lot of the underweights this morning, or the kind of ones that aren't rallying as much, are based in France. You can see in the CAC 40 down about 0.2%, we'll call it. LVMH a big part of that trade.
Yeah, you're certainly going to find more of the UK-based businesses to the top end of things, aren't you? And I'm just looking at the best performing sector, which is real estate, and there's a lot of PLCs in there, so there's a lot of London catching up with yesterday's gains. But I'd also throw in the fact that we're seeing lower long-term yields, and real estate, obviously, and this is away from the UK narrative, but globally lower long-term yields. And I wonder if the real estate sector is responding a little bit to that, because we've witnessed, of course, some substantial movements at the long end. And I'll add in the UK there, because we are seeing that the UK 30-year yield, I think that is today's, yes, we are seeing the 30-year down by 6 basis points. So that is something that can boost those real estate businesses.
Yeah, but they are dealing with what seems to be a very sticky, and I appreciate we're getting some movement this morning, longer-term story. Rheinmetall is up quite strongly in terms of the points that are adding. We are seeing the defence story coming through. That maybe is a feed off what we're seeing with the Friedrich Merz narrative around allowing long-range missiles to be used in Ukraine and fired into Russia. I wonder whether there's a reaction there as well. HSBC is up, Rolls-Royce is up, BAE Systems is up. The defence story, therefore, is actually having a fairly good morning this morning. We were looking earlier on for maybe some narrative around maybe the mining stocks coming under a little bit of pressure. I don't necessarily see that this morning. Rio is off. It's off a little bit. Let me just narrow it down by around 1% this morning. So there's some weakness coming through. But there's definite weakness in the luxury sector this morning, as you say, Critty, out of France.
I wonder how much of that is simply kind of a hangover from the tariff trade, or even some of the China's data as well. It just, this market feels like something is just kind of shaking out, catching up to the news, and maybe is on equal footing when it comes to tomorrow. Maybe we'll see a little bit more there. We also should keep one eye on the bond market as well, though, because you are seeing that bid into the bond market is certainly more pronounced. We'll get to that in just a moment. But let's bring our markets guest in this morning. Nancy Curtin, CIO at Alti Tiedemann Global, joined us around the table. Nancy, a pleasure to have you on the program. We're seeing perhaps a bit of a cautious trade in the equity picture this morning, but certain panic, it feels like, in the bond market. That volatility perhaps responding to questions or around whether the American exceptionalism trade should still be there. Your thoughts?
Look, a bit like Mark Twain, the death of America is greatly over-exaggerated, as is the dollar. Having said that, we have believed that the term premium will rise in the United States. In other words, the compensation that investors demand for taking a position in longer-term governments in the United States, we not only have the fiscal challenge, and we have that tax bill winding its way through Congress, but we have perhaps a bus, which is anything but the United States. In other words, at the margin, we do believe that foreigners will think about their allocations to the United States, not sell it all, but maybe allocate less or hedge, and we think that has implications for both a lower dollar and or a higher cost of capital, both of which we're seeing at the moment.
So don't underwrite America.
Don't.
Why?
Because, look, the innovation and dynamicism of the economy, and also we only have Trump for another couple of years here on top of that. So there's huge amounts of, I think, great viability in the United States. And, of course, Gen AI didn't die in the last 4 to 5 weeks, and the U.S. is the clear leader there. Look at the deals that happened coming out of the Middle East when Trump was there about a week or so ago. So, yeah, don't underwrite or write off the United States, but we do believe in a higher cost of capital in the United States. That's going to be part and parcel of what Trump will need to deal with going forward.
A higher cost of capital, and that takes us to what's going on at the long end of bond markets today, looking very different to Thursday. Thursday last week, we saw this surge at the long end, and that was Treasuries, it was JGBs. So this is something of a global story. But thinking about the US, can the markets, or will the markets, focus once again on that, or can the markets move on to think about growth? Because in that same tax bill that got everybody worried about the fiscal position, there were also things that you could get excited about growth if that's where your head's at.
Well, funnily enough, while we're worried about the term premium rising, we also think the tax bill is pro-cyclical. And within that tax bill, I think there's a couple of things to comment on. Number one, it's better off we have the tax bill going through than not. Otherwise, taxes would go up for 80% of Americans. That would not be a good thing. That would be a bit of austerity to come. Number two, within the tax bill, as you sort of hinted at, is embedded a lot of incentives for companies to invest. Bonus depreciation, expensing of R&D, and increase in deductions for interest costs. These are pretty positive from an investment spend perspective. And by the way, if President Trump does get through a baseline of tariffs, call it 10 to 12%, and makes them permanent over the next decade, that would raise something like $3 to $4 trillion. Again, that's the number that gets added from the tax bill. So, again, I think there are some counterbalancing influences, but you're absolutely right. The tax bill is pro-growth, pro-cyclical, and we think investors will focus on that as well.
In terms of those incentives for global business to invest in the United States then, Nancy, are these, should we get excited about that in the context of the IRA tax incentives being removed? You're citing other ones here, and there's so much detail in this tax bill. I mean, are we going to see that being enough to offset businesses' nervousness around an ever-changing tariff environment?
I mean, it is hard to say, but at the moment we've seen about $2 trillion plus of announcements. Okay, announcements is not the same thing as breaking ground, but to invest in increased production in the United States. That in combination with the tax incentives are positive for investment. Of course, we have to time box this uncertainty. We've got to get through a number of different trade deals. And remember, TikTok, we have 43 days here left until July 9th. So, we've only had the UK so far. We need to see some progress on these trade negotiations as well.
Can Americans continue to buy equities when the rest of the world isn't buying the same equities? What is the trade here? At the moment, it feels like every time there's a dip, US retail steps in and buys. That is the muscle memory that has existed for the last 15 years or so. It has worked. It continues to work. It's continued to deliver. Is that still the trade? Because I'm hearing different message from US retail, from US institutional, and from external investors as well. They're all seeming to think different things at the moment. But US retail continues to buy. Is that the right trade?
Well, thank you, Mr. Retail, because that's what brought the market back up again, nearly 17%, give or take, really, from the lows. You're right. We are cautious. Institutions are cautious at the moment. But cautious at the moment because we've got a lot of headline risk. We've got a tax bill. We've got tariff negotiations. We have a debt ceiling. We have a lot to get through in the next couple of months. Having said that, it's been our view that the U.S. will slow but not go into recession. There's a number of different shock absorbers, the wealth effect, still strong jobs market, tax deregulation, deregulation. Gen AI, as I said, didn't die in the last 4 weeks. So we do think there are some significant counterbalancing influences that we think will keep the U.S. on track, and we think earnings growth will actually prove to be more resilient than investors think. So maybe Mr. Retail isn't wrong over the longer term.
Can everybody be right at the same time? And I ask this question, the euro is a massive, the dollar is a headwind now for international investors. I keep coming back to this. When you have conversations here in London, are they different to the conversations that you're having over in the United States? At the moment, the United States, the economy looks okay, things are ticking along, equity might go up a little bit, but if I back out the dollar trade, then I'm actually, as a European investor, lower. Can US retail benefit and see a market that rises gradually and keeps going, but the rest of the world has a different perception of that market because of the fact that you put an FX overlay on it, which is much more negative?
Well, for our clients, we are looking at hedging what we call parts of the portfolio, like bonds and credit and infrastructure, things that we think we want to make sure are hedged back to base currency for our clients. But with respect to global equities, pretty hard to hedge. I mean, Microsoft, I don't know, how would you hedge that? It's got global revenues in lots of different places in the world. More importantly, when the dollar declines, and it's down about 7-8% so far year to date, that adds about 4% to earnings. So a lower dollar isn't necessarily negative.
Do they counter each other? Because you can argue the other way around.
50 basis points. So let's say, 8% decline is a 4% add to earnings. So that's a good thing. We had the largest buybacks almost in history in the first quarter, $550 billion. And remember, those tax incentives that I mentioned is like equivalent to a corporate tax cut. So there are some things that are positive here. But you're right, at the margin, as I said, we think foreigners are going to think about their allocation and certainly hedge part of their exposure to the United States, certainly in government bonds.
Sure, restructuring, and that's, I feel like that happens cyclically every, 5-10 years, pretty much?
I think this is really a very significant shift, because over the last 2 decades, it made a ton of sense to own America. The dollar was rising, every asset class was underperforming. If you weren't overweight America or had a very substantial position, typically unhedged, you were hurting in performance terms. So we think this will get unwind, and this has, as I said, implications for perhaps a lower dollar and a higher cost of capital for the U.S. That's the price of Fortress America.
You mentioned the bond market specifically. That could be kind of the straw that breaks this camel's back. There's a question right now of just how much domestic, not just buyers in terms of pensions and endowments, but the banks themselves can absorb some of that supply if we do get to a point where Scott Bessent does have to ultimately tap more, and the bond market can get a little bit more issuance there as well. To the folks you're speaking to, is that absorbability a concern?
I mean, remember, there's deregulation on the horizon, and if they lower the SLR rate for, for banks, they could buy more government bonds, because right now, if they buy government bonds, they get a sort of risk, capital charge. So that could be something. I think there's also, Scott Bessent's been thinking about, okay, could Europe buy a 100-year bond as a way of exchanging for increased defense spending or security from the United States? So I have a feeling that there are things up the sleeve of the administration to absorb. And remember, household wealth is still, kind of $70 trillion and counting in the United States. So there's a lot of wealth there to buy into the debt. But you're right. We do think term premiums will rise.
But what do you do in the intermediate? I mean, there are gaps between the tax bill that gets potentially passed through the Senate, ultimately debt ceiling in July, the issuance, the SLR changes. These are all pieces that could, and then trade deals on top of that. There are lags in between. They don't all happen at once. What's the trade in the intermediate, in between those gaps?
Stay still. One thing we've learned from what happened in April and now in May is that trying to trade, and last Friday, trying to trade these markets is fraught with uncertainty. There's a lot of wealth being vaporized for people that are going down, and then the markets go back up again. We say to our clients, you're long-term investors, stick with the plan, stick with your asset allocation, and don't try to trade these markets. And by the way, we're global investors, so we have the U.S., we have international markets, which have done incredibly well, so that diversification is the best risk mitigant during this particularly turbulent time. But yes, caution near term in terms of markets.
Nancy, thanks for stopping by. Really nice to see you once again. Nancy Coe, CIO at LT Tiedemann Global. Let's take a quick look at the Core 6. This is what the picture looks like. We find ourselves in a situation where you have two different markets, effectively, the UK market versus what it's seeing in the rest of Europe. But there's some diversification within Europe. Luxury is under maybe a little bit more pressure than we are seeing elsewhere. As you can see, you get LVMH trading down nearly 1% this morning. What else are we watching? Let's find out. Joe Easton's back with some details.
So we are seeing some movement in the defence stocks. Guy, as you mentioned, kind of two different stories in Europe today with the UK catching up. So we've brought up the UK names because BAE Systems, Kinetic, Babcock, all of the UK-listed defence companies kind of catching up with what we saw yesterday with that move higher in defence stocks. Rheinmetall was up around 3%, and there is focus again on the NATO spending, potentially countries coming up to 5% of GDP. Will that actually be confirmed? We have got a bit of an upgrade for Kinetic or Kinetic Q over at Kepler. So the UK company's kind of doing that catch-up trade this morning. And then we've also got some watchmakers on our radar. Now, the watch numbers out of Switzerland actually look pretty good, up around 18% as we see down the bottom there in the latest quarter. And the US numbers, Americans buying loads of fancy expensive watches according to that data, because actually the sales almost doubled on a year-on-year basis. Potentially there was a little bit of a comparative issue with that data, but the stock's coming down a bit, potentially kind of due to the weakness we're seeing in broader luxury, as Guy mentioned a moment ago, which does bring me on to the luxury movers. We have also got LVMH slipping a price target cut over at HSBC, and HSBC actually talking about a weaker US consumer continuing to wait. It's kind of in line with the other commentary we've seen from the conferences in recent weeks. Luxury, the outlook in general, still looking a little bit soft, and broadly as well, Kering and Moncler coming down. The one stock outperforming in luxury today is actually Burberry, upgraded over at Barclays this morning. They reckon that the cost savings at the company, we saw headlines on that a few weeks ago, potentially going to boost Burberry. So that one doing pretty well. We're up 1.7% for Burberry this morning. Then in chemicals, we have got news of a bit of a legal issue for Clariant, getting a lawsuit from OMV saying that they're copying some of their copyright or some of their rights or patents to a certain chemical that is used in making plastic. Very glamorous in terms of that market, but that is weighing on Clariant over in Switzerland. We're coming down 1.5% at the moment on that one. A bit of weakness in chemicals today. And then finally, the maker of Panadol and other painkillers, Sensodyne toothpaste, I think they do as well. Haleon upgraded to outperform over at Exane. That's a spinner from GlaxoSmithKline, of course. That stock has rallied, but they reckon that it could come up to 500 pence a piece if they hit their profit targets. So Haleon in the painkiller market up around 1% in London this morning.
Thank you very much, Joe Easton from our equity team with a look at some of those stocks that are moving. No pain in gilt markets this morning, really taking its lead from, I was going to say treasuries, almost identical to what's going on in treasuries, but they in turn taking their lead from Japan. So we see yields on the long end of the gilt curve down by 8 basis points, and that's 30, 40 and 50 year, of course, here in the UK, and really echoing the 30-year move in treasuries then, down by 8 basis points, Guy, at the long end of the US market.
Coming up, we're going to be talking about what is happening with the European car sales story, slipping in April. Major markets, including Germany, France and the UK, all posting declines. I think BYD may have overtaken Tesla. You want to take a look at that data. We'll do it in more detail next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology. The the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Welcome back to the opening trade. We are 20 minutes into our European session that sees the London market playing a little bit of catch-up, up by 0.6%, while the rest of Europe pretty much flat, either side of the flat line in the German market and the French market. Now, let's turn our attention to some corporate news flow, though, that has made headlines. Bloomberg has learned that HSBC has cut more than 24 analysts in recent days as Europe's largest lender deepens a restructuring of its investment banking businesses. Sources say that the cuts, mostly in Europe, include the departure of Stephen Major, global head of fixed income research. For more, Bloomberg's Steve Ahrens joins us now. So what's happening here, Steve, and what's the driver?
Well, as you said, there's restructuring going on. There's a new CEO who came in last year. He's trying to cut costs, and so job cuts are clearly part of that cost-cutting drive. Even though the roles, we're talking about a few dozen here, it's not a huge number. Remember, HSBC is a vast bank, but as he also said, it involves some really senior people, and clearly shows that he's taken, the new CEO has taken, a very harsh approach to his cost cutting.
But why now, Stephen? This has been a dynamic that's been in play for quite some time. Why now?
You know, the new CEO came in September. He unveiled a sort of new strategy involving an efficiency drive in October, and has since then repeatedly involved new measures, including investment banking cuts earlier this year, also targeting Europe. So it's a continuation of that drive that focuses on sort of streamlining HSBC's presence in Europe, focusing it more on Asia. And this is clearly part of it. As you said, most of the roles that are to go will go in Europe. And so he's taken step after step to achieve his goal.
All right, Stephen Ahrens walking us through the dynamic at HSBC. Those shares higher by 0.6%. I'd say part of that's a catch-up trade, part of that perhaps responding to this news.
Let's turn to the auto sector and figure out what is happening there. European car sales data dropping in April amid weaker economic growth and uncertainty due to global trade tensions that's prompted consumers maybe to hold off on larger purchases. Bloomberg's Danny Lee joins us now on the details of what we've learned. Work us through the numbers, Danny. Talk us through what these numbers tell us about what demand looks like. Bigger picture. We'll get into the specifics of the individual companies in a moment.
Yeah, good morning, Guy. This is largely bad news. For the third time in 4 months, we are seeing a decline in sales across Europe. it's a big major market, and when you look further deeper into the picture, it's some of the big markets which are slipping, such as Germany, France, and the UK. So it is a bit of a struggle, given the broader macroeconomic backdrop, the slowdown in growth, and the uncertainty around tariffs, which is really kind of dogging the picture for consumers and thinking about making large purchases. So there is a challenge there, and it's not a good time for the European automakers and the European auto sector when they're having to confront challenges from Chinese competition and then these tariffs from the US.
So, Danny, what about the Tesla dynamic? Because we know from reports we've seen already that Tesla has been struggling in Europe. Is that held up again? Is that something that's happening once again in this monthly report?
Yeah, Tesla falling, sales falling by half, so down to 7,200 units, and that compares with the overall picture in Europe when we saw sales slip 0.3% to 1.08 million units. So, Elon Musk has been very robust in recent times, saying that this sales collapse it's seeing in Europe is just isolated. But when you look at the broader picture, its peers are not suffering the same kind of declines. And so, for Tesla, it's a blow. And kind of the watershed moment that we have seen is that the likes of BYD, China's BYD, a big competitor to Tesla, has managed to overtake Tesla in sales according to some market research data. And then when you look at some of the official data from the ACEA, SAIC Motors, a big Chinese state-backed automaker, has also managed to overcome Tesla in sales year to date so far. So it's a big turnaround and not a great looking one for Tesla at the moment.
Danny, very quickly, give us the update on Volvo Cars.
Yeah, Volvo cutting 3,000 jobs, so 7% of the workforce out of 44,000 workers. So it's a big restructuring they're undertaking, given their struggles in earnings. They're trying to make these cuts to get ahead of a weaker profitability. They missed out on earnings a couple of weeks ago, and they are going to have to confront real challenges with US tariffs as well. So that, along with weakened consumer demand, under new management, they are really having to take action, and this is part of a broader 18 billion Swedish krona plan to try and stop the Volvo ship from sinking.
All right, Bloomberg's Danny Lee walking us through the car-making story, both of Volvo Cars and BYD and Tesla as well. We thank you so much for walking us through that story. As Danny was speaking, we should just get a quick check on these markets here, because when the bid for the bonds, at least in the States and over in Asia, were intensifying, futures in the meantime picking up as well.
Yeah, absolutely. That link does seem to be playing out, doesn't it? Even if US futures were initially higher on optimism around trade, the fact that we're seeing those long end yields coming down from Japan to the UK to treasuries, that does seem to be pushing futures a little bit higher. NASDAQ futures up by 1.5%, which is a good 0.5% higher than they were at the start of this program, I think.
Yeah, we're certainly seeing a little bit of a pickup. I don't think you're seeing much of a pickup. If you take a look at the 3-day chart, we're basically kind of where we were throughout most of yesterday's session. We've picked up a little bit versus Friday. So I don't think you're not seeing that much action in this market just yet. A little bit.
Coming up, we'll focus on some of the geopolitics playing out in Eastern Europe. Ukraine's Western allies are trying to intensify pressure on the Kremlin. We'll be joined by sanctions expert Tom Keating. That conversation coming up shortly. This is Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit. and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
This is the opening trade. About 30 minutes into today's session, we are seeing green on screen across the board, but perhaps not by the massive margin that we were expecting, unless you look at the FTSE 100. A little bit of a catch-up trade there right here in London, higher by about 0.6%, but starting to see that sentiment at the open that was at least 30 minutes ago. Was a little bit softer, now higher by 0.2%. I guess you can call that a little bit of bullishness as well. One sector that stands out, of course, is going to be the defense sector. We are seeing some major gains when it comes to that. Perhaps the news around Ukraine and the green light out of Germany moving those stocks.
Absolutely. Let's talk about where that is coming from then, the impetus for those moves. Chancellor Friedrich Merz says Germany is no longer imposing range restrictions on weapons supply to Ukraine, bringing it into line with the United States and the UK. It comes as Kyiv's Western allies attempt to intensify pressure on Russia after it launched its biggest drone barrage against Ukraine since the full-scale invasion over 3 years ago. Let's bring in Bloomberg's Russia economy and government editor Greg Sullivan, who has details of what's driving this change in stance, perhaps from Germany. So, Greg, what's the significance of this move by Friedrich Merz, and how much does it likely help Ukraine on the battlefield?
Well, it's a pretty significant move, this widening, lifting the limits on ranges that they can use German-supplied weapons. It's something that Ukraine has long been asking for. Ukraine wants the capability to degrade Russian military force within Russia's own borders. That's striking things like airfields, weapons storages, oil and fuel depots that aid the Russian war machine and its ability to attack Ukraine. This move by Germany also puts it more in line with the U.S. and the UK. The U.S. has allowed Ukraine to use its ATACMS missiles, while the UK has allowed its Storm Shadow missiles to be fired into Russia. So that sort of more aligns them with other Western powers. But it also raises the risk that Russia will see this as a provocation. Already yesterday, we heard from the Kremlin that they said that this was a dangerous move and likely to widen the conflict. And there are also other questions that remain. While it's likely to help Ukraine, that would depend on how much weaponry Ukraine has. What are its long-range weapons supplies? Will it receive more supplies? So far, Germany has refused to provide the Taurus missiles, those long-range missiles, to Ukraine. So still a lot of questions even after this announcement.
Well, Greg, that green light is something that was already given by, I believe, the Biden administration previously as well, I think last year, in terms of those long-range attacks as well. How is this different, or how does this expand the story from the broader pressure likely coming from NATO?
Well, there's a few things here. You're right that the U.S. has given the green light to Ukraine, and of course they've in the past used the ATACMS missiles in the Kursk region. But now there's the broader question of what kind of U.S. supplies will still remain with the Trump administration. Obviously, Trump has suspended military aid once before resuming supplies. There was obviously questions about whether there will be new supplies. Trump has been very critical of aiding Ukraine during this military conflict. And in the broader ceasefire negotiations, now it's looking as if Trump has given signals that he may be willing to walk away if there isn't broader progress. And so far, there hasn't been progress in the ceasefire. So those questions remain from the U.S. side. And now we have Germany saying, well, potentially, but again, if there is no German weapons supplies that are long range, it's unclear what this exactly means on that front.
Yeah, we still need some details. Greg, great to catch up. Thank you very much indeed for updating us on what is happening. Greg Sullivan joining us on the, let's call it the kinetic side of the equation of how the West is responding to Russia. Let's continue that theme, but maybe from a different angle. The US President Donald Trump has said he was, quote, absolutely considering new sanctions against Russia following intensified attacks on Ukraine's capital. It comes as the EU consults member states on its next sanctions package, the bloc's 18th since Russia's full-scale invasion of Ukraine over 3 years ago. Let's bring in Tom Keating, founding director of the Center for Finance and Security at the Royal United Services Institute, RUSI. Tom, great to catch up. Thanks for joining us. 18th package, that's what we're dealing with out of Europe. We were just talking about the kind of kinetic side of how Europe is dealing and trying to persuade Russia to withdraw. Let's talk about how the financial side of that equation is playing out. We've got the 18th round of sanctions being talked about right now. How effective have the previous 17 rounds been in deterring Russia from taking action in Ukraine, do you think?
Well, the short version is the war continues, and therefore you could argue the sanctions have not been effective, but they have degraded the Russian ability to pursue its war through two lines: reduce funding, so go back 3 years, the foreign exchange reserves of the Central Bank of Russia were frozen, mainly in Belgium, and then access to the technology that Russia needs is being restricted. But it's all happening too slowly. Promise of massive sanctions are repeatedly made by European leaders, and yet we are moving at a glacial pace, sadly, for the Ukrainians.
Does that mean ultimately that the Russians can outpace any sanctions that are applied? And if so, what would be effective at this point?
It's a mindset difference. So for the Kremlin, outpacing sanctions is existential. If Russia does not outpace sanctions, then its economy will collapse and its war will fail. In Europe, we continue to think that we can issue sanctions that will hurt Russia without hurting ourselves. And this is obviously a political challenge for leadership in Europe. If we really wanted to crush the Russian economy, crush its ability to fund its war in Ukraine, then we would have targeted energy sources, LNG, oil, and so on, much, much harder a long time ago. And that's why it's interesting to see what people like Lindsey Graham are talking about in the United States. There's a willingness in the US, it sounds, to go after oil sales in a way that at the moment in Europe we're just not prepared to do.
Yes, I mean, so with that in mind, Tom, how do you evaluate the G7's failure to agree on bringing down that price cap on Russian oil, seaborne oil, the price at which it must not go above if it's to be insured and transported by Western infrastructure?
Well, the oil price cap was a great idea, saying to countries like India and China 3 years ago, you are welcome to buy Russian oil as long as you buy it at a below market price. What's not to like about that? But frankly, the development of the so-called shadow fleet, the ability of Russia to continue to sell its oil around the world to willing buyers, has made a mockery of the oil price cap. And so that's why I think ideas such as the one put forward by Lindsey Graham to say, if you choose to buy Russian oil, then we will punish you, China, India, and others. We have to go after the supply side. We see from the way in which the Russians react when the oil price drops, for example, how painful that is for them. So if we can stop them from being able to sell their oil, curtail the shadow fleet, then we might be onto something. But at the moment, sadly, we're just nibbling at the edges in Europe. We need to be much harder and go much faster.
Yes, I mean, I suppose some people might push back and talk about sovereignty and independent nations being able to decide for themselves. China maybe and India decide for themselves whether they want to take Russian oil, and it might seem a little extraterritorial if the US Republican plan were to be enacted and put 500% tariffs on countries that do buy Russian energy. I suppose it could be done, though, just to force people to the table. Would that be the aim, Tom?
Look, I think fundamentally, you start using the word extraterritorial, the people acting extraterritorially are the Russians by invading Ukraine. I think everybody would want this war to end. At the very least, it's a distraction in international relations, and of course, it's a tragedy for the Ukrainian people. There are other sources of oil. You don't need to buy Russian oil if you're China or India, and they're choosing to prolong the war in Ukraine by funding the Russian government. So we haven't seen any sanctions from the United States on Russia since Donald Trump took over the presidency in January. And now, if he really is, quote unquote, pissed off, very angry, etc., with Vladimir Putin, would be the time to follow the lead of the likes of Lindsey Graham. And it's also the time for the Europeans to step forward with the, again, quote unquote, massive sanctions that they've repeatedly promised but not delivered.
Thomas Creedy in London, prior to Donald Trump's most latest comments, as you put them, on Vladimir Putin and simply being annoyed by that, he's previously talked about recreating a trade relationship with Russia. It doesn't really seem on the table at the moment, but he has made that comment in the past, which at the time begged the question of what a rehabilitation of Russia in the global economy actually looks like. Tom, from your perspective, is that still a possibility?
Well, it's a real worry for Europeans. We know that Vladimir Putin loves to drive wedges between allies, whether it's between European Union member states or whether it's a transatlantic wedge. And of course, if the Kremlin were to play its cards in a certain way, it would offer trade opportunities to Donald Trump. Nobody likes a deal more than Donald Trump, and that would be a classic way of the Kremlin driving a wedge across the Atlantic. So imagine, for example, Boeing being given lots of interesting deals by Russia, but Airbus continuing to be frozen out. That's a nightmare scenario for the Europeans. So I'm not surprised to hear talk of deals. I'm sure on these long phone calls that Donald Trump has with Vladimir Putin, Putin dangles deals like that for him. So this isn't over, and the Trump administration has yet to put sanctions on Russia. So until we see that happening, we have to assume that Trump is more interested in rapprochement with the Kremlin than he is in ending the war in Ukraine using tough sanctions on Russia.
Well, Tom, you talk about those kind of carrots that may be used in terms of enticing Donald Trump. Talk to us a little bit about the energy space as well, because you specifically said that the EU has been hesitant to acknowledge and really address that part of the sanctions market. What would it take to get there?
Well, let's talk about Russian oil primarily. I mean, at the end of the day, the Europeans control more or less the export of Russian oil because it passes through the Baltic Sea, it passes through the Danish Straits, it passes through the English Channel, it passes through the Straits of Gibraltar. Those are all stretches of water that Europeans control. But of course, international maritime law and the rights of innocent passage mean that it's very difficult to disrupt those tankers. What we have started to see in the Baltic Sea is countries like Estonia being creative with the way in which they try and interdict vessels that they suspect are carrying Russian oil at a price above the price cap. So fundamentally, we need to see more of what the UK has done actually over the last 2 or 3 weeks, which is sanctioning vessels that are operating in breach of the oil price cap. We need to see sanctions on infrastructure, so that means the brokers that are selling these tankers to the shadow fleet, the Chinese refineries that are refining, and really, as I say, go full court press on the oil side, because without that revenue, the Kremlin is lost. And we can see just from daily reporting how the cost of groceries and the ability of general Russians to kind of lead their lives is being impacted by this. But we haven't been willing to press our foot to the floor, and that's what we need to do now if we want to end this.
Tom, Europe has been through an energy crisis over the last few years. Would what you suggest cause a similar outcome? What would it do to European industry, and what would it do to European consumers? Because politicians are short-term thinkers. and they worry about these kinds of things. And so I'm wondering what the kind of the net effect of this will be in Europe. The resistance to doing this seems obvious because of those sorts of concerns. Am I barking up the right tree when I think about it along those sort of lines? Because that's a really big story to overcome.
Yeah, no, look, you're absolutely right. And indeed, in some countries like Hungary and Slovakia, in a way, that argument has already been won. That's why the Hungarians and Slovakians are so negative and push back on EU sanctions. I mean, if I had a euro for every time I've heard an official in the German foreign ministry, for example, say, Tom, you've got to understand, we have Mittelstand companies that have long-standing relationships with Russian companies. It'd be very difficult to tell them to stop trading with Russia. You know, ultimately, it's a political choice. It's a political choice. And the only way in which Europe is going to really demonstrate resolve when it comes to sanctions is to be willing to take a bit of pain. And over the last 3.5 years, we haven't been willing to take that pain to the extent that is necessary. And as I said earlier, for the Kremlin, avoiding sanctions is existential. And in a way, we need to treat it with the same urgency and vigor in Europe if we want the sanctions to work. If we simply want to drag this out for years and years and years, then carry on doing sanctions the way we are.
Yep. I remember taking a undergraduate course a long time ago talking about sanctions being for domestic purposes rather than actually to achieve anything when it comes to the stated purpose. But that was a long time ago. Maybe things have changed. Tom Keating, Director of the Centre for Finance and Security at RUSI. Thank you very much indeed. Coming up, the EU agrees to accelerate trade negotiations with Washington to avoid a transatlantic trade war. We will have the details of that story next and the reality of it as well. This is Bloomberg.
What would it mean for India to host the Olympics?
Linda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to the opening trade. About 47 minutes into today's session, seeing green on the screen across the board. Actually, a real rebound. People are buying 47 minutes into the session. We did not see this kind of action at the open. Higher by 0.5% on the stock 600. But again, the outperformer is going to be right here in the UK, the FTSE 100. Really a catch-up trade, higher by about 1%, but you are seeing some optimism over in the States as well. At the same time, the bond market on both sides of the Atlantic catches a bid. In the meantime, as we digest all of this market pricing, let me bring you some headlines in the banking sector. UniCredit, some headlines crossing there when it comes to that banking consolidation story out of Italy. I'm going to a couple of different pieces, so roll with me on this one. Andrea Orcel, the CEO over at UniCredit, rules out any move when it comes to Generali, the major Italian insurer. They do have a stake in that, but they're not looking to increase that into a takeover offer. So that piece is key. The other piece of this is that he's also saying that if the BPM deal does not get approved by the courts in time, it could lapse altogether. And that's the takeover bid that everyone's watching in terms of UniCredit and the share prices there. Nevertheless, you are seeing Banco BPM shares higher by 0.4%. UniCredit shares higher as well. So it doesn't feel like these latest comments are making a dent, but anything can happen in Italy.
Right, and we'll continue to watch the broader European banking sector with deadlines approaching there around M&A. Now, the EU says it will accelerate negotiations with the United States to avoid a transatlantic trade war, days after President Donald Trump criticized the bloc for taking advantage of the US and slow-walking talks. That's his view, of course. I'm joined now by Bloomberg's Oliver Crook in Berlin. Ollie, good morning again. So talk us through the European response here. We heard Ursula von der Leyen had a conversation with President Trump over the weekend, and then yesterday we continued to get this more hurried mood music, I suppose, from the European side.
Yeah, and I think mood music is the right way to characterize it. I don't think there's anything necessarily substantive in terms of what a fast-track deal discussion actually looks like. We don't have any clarity on that, but that is what the EU Commission is now saying. We also had Maro Sefcovic, the sort of top trade official here in the European Union, speaking with Howard Lutnick, the U.S. Commerce Secretary, and Jameson Greer, the U.S. Trade Representative, yesterday. So those conversations were ongoing. But again, what is lacking here is any kind of substance, architecture, framework for us to dig our teeth into and to really get an idea of where the sticking points are. It seems what's been going on is the EU has been going to the United States, trying to read the crystal ball to understand precisely what it is exactly they want, coming up with proposals that seem to be too abstract for the Trump administration's liking, and then basically being shunned and pushed away, and then ending with Donald Trump saying that there's going to actually be 50% tariffs on the EU if they fail to reach that deal by July the 9th, which is now the deadline. And that was going to initially be 20% tariff. That now means 50% tariffs, and that is the thing that everybody is staring down. And of course, for the Europeans, this is a much greater risk than for the United States. That being said, according to Bloomberg Economics, this will still cost the United States about 0.5 percentage point of growth if you do get 50% tariffs on July the 9th.
Let's talk about what else is going on, because it's interesting. There's a sort of twin-track strategy being applied by the Europeans. They're talking to the United States, trying to figure out what the relationship could look like there. But they're also talking to the Chinese as well. And we've got talks coming up in a few weeks' time. And I'm wondering whether we need to kind of compare and contrast what is happening with the view west and the view east.
I think absolutely. I think that, for the time being, there is very limited appetite, and we should say this, within the European Union overall for many of the member states to really say, listen, we're going to give up on the United States, we're going to move towards China and have a more open relationship in terms of trade and other things with the Chinese. You have heard some explicit calls for that, specifically from the Spanish, but that has not really gained full traction across the EU. But what we are getting is that top-level trade discussion on the sidelines of that summit in Paris. This will happen in June between Maro Sefcovic and the Chinese Commerce Secretary. But also, Guy, the other thing to look forward to is from the EU leaders. There's going to be a big EU leader trip to Beijing in July, where a number of the leaders across Europe are going to go to China. That'll coincide just about with that July 9th tariff deadline with the United States. If things are not able to move forward with the United States, there's going to have to be a conversation about what this posture is towards China. Maybe China will be willing to address some of the industrial concerns that the Europeans have flagged before. Maybe consumer sentiment will shift. I mean, if you look at the auto market today, there certainly has been a move away from Tesla, the United States, and towards BYD, which has just overtaken Tesla for the first time here in April. Maybe that is not where we should be getting all of our geopolitical and trade cues, but it's something that's certainly present in the conversation.
Ollie, great stuff. Thank you very much indeed for the update. Bloomberg's Ollie Crook joining us out of Berlin. Let's carry on looking at this from various different angles. Blowback from the Trump administration policy certainly putting pressure on global investment flows, with so-called revenge taxes and fund managers in Europe maybe taking a different view of how assets should be managed. Let's talk about all of this. Charlie joins us around the table to figure it all out. There's various kind of buckets of this story, one of which is this revenge tax in the United States, which is aimed at digital taxes, etc., being applied in Europe. And the concern here is that basically the US will up a withholding tax to compensate. Talk us through this story, because this could limit passive funds being held by foreigners in the United States.
That's right, guys. So the Trump administration cannot stand digital services taxes. So these are the sort of levies that we see in places like the UK and France and Italy. And basically, they are taxes on revenue generated from users in those countries. And the Republicans don't like this. The tech firms from the US do not like this. And this has been a real sticking point in a lot of these trade negotiations we've been seeing. We've heard Bessent talk about these digital services taxes. And so this is how we're seeing Republicans take them on. And what they are basically saying is, if you are an investor from one of these countries that has the likes of a digital services tax, you are going to see the passive income from your investments in the United States. You're going to see that tax obligation go up. So this is a way to ratchet up pressure on these investors. If you are an investor in the U.S. from one of these countries, you're not going to be happy about this.
How possible is it that this actually comes to fruition? Because at the moment, this is an idea of an idea.
Yeah, this is an idea of an idea, and it is in the bill that was just passed in the House. It is Section 899. We know that this is now going to have to go to the Senate, and there is so much wrangling, so much negotiation that is going to happen between those points. But this has been a talking point between a number of the countries. We've heard it come up with the UK, talking to the US, for instance. And there's a world where investors put pressure on this because they do not like what they're hearing. They do not want to see their tax obligations go up on the back of this.
So that's one story that could dictate flows across the Atlantic to some degree. Another one that we're focusing on increasingly is the attitude of pension funds with big pots to invest and where they put them and the criteria attached. So we've got some really interesting reporting around European pension funds and what they make of money managers in the US and their willingness to stand up to Trump or not.
Again, if you are a US asset manager, this is another risk that you've got to think about. So you're thinking about the Trump administration. You're thinking about how kind of ESG policies are out of favor on that side of the Atlantic. Come to this side of the Atlantic, and you've got warnings from the likes of PME. They're one of the largest pension funds in the Netherlands, and they are basically saying, hey, U.S. asset managers, we do not like how you are not standing up to the Trump administration. We do not like how you are kind of shirking on a lot of this ESG requirements. We do not like what you're doing vis-a-vis the Trump administration and the judiciary. So this is another risk that the like of, say, State Street and BlackRock face, and some of these firms are already losing mandates in Europe. So this is a real risk that they're facing. And basically, PME saying that they're going to use a new framework. They're rolling out a new framework for kind of evaluating these asset managers. And again, if they don't like what they're hearing, they could end these mandates.
All right, Charlie Wells walking us through, as I think I did earlier, the pots of money that could move. We thank you so much for walking us through this all the crucial stories. Charlie Wells driving us to it. Let's talk about these markets here, because we've seen a real game changer in terms of how these markets are faring. I'm looking at futures over in the States, higher by 1.5%. A lot of that seems to be not just the catch-up trade in the FTSE 100, but you are seeing some optimism in some of the other European sectors that we're keeping an eye on as well, Guy.
Not much of a move at the front end, which is surprising given actually the French CPI data that we saw. So we've got front-end yields down a little bit. The move is really at the back end. So you've got a curve flattening trade that's being put on this morning in the bond market. But the CPI data doesn't seem to have generated a big response at this stage, which in some ways you can argue is a surprise. It's a decent miss to the downside.
Yeah, it's a decent miss to the downside. 0.7% year on year is
well below 2%.
Well below 2%, and so far away from where we've been when it comes to European inflation.
Yep.
I mean, how much more quickly do we get to conversations about European rate cuts? That certainly will be something we think about as we watch for other European data points to drop into place around inflation. Don't miss our exclusive conversation with Thomas Barkin, of course, of the Richmond Fed, 2:30 p.m. UK time. This is Bloomberg.
world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance. Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Is this a negotiation or the new rules of the game? It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
The EU steps up trade talks, saying it will fast-track negotiations with the U.S. and plans to meet Chinese officials early next month. A sharp fall in Japan's super-long bond yields after an unusual move by the finance ministry as it seeks to regain stability. Plus, Germany drops its opposition to Ukraine using long-range missiles to hit Russia as allies intensify the pressure on Vladimir Putin. So there's a lot going on in the markets. There's a lot going on in geopolitics. So let's round it up all together. Now, cross assets, look, what I'm looking at is, of course, a lot of the equities moving. If you look at futures in the U.S., look, the dollar bouncing back, equity futures for the S&P 500, but also the NASDAQ up around 1%, S&P actually 1.5% higher. And this is as the President, Donald Trump, extended some of the deadlines implementing aggressive euro area tariffs. So we're on the back of what we saw yesterday, which was a bit of a risk-on move. Long-term government bond yields in Europe, but also Asia actually fell. Again, other currencies declining as investors reacting to the news from Japan. So you can see, yen 143.73. Again, Japan's finance minister was asking market participants for their views on government debt issuance, leading to a bond rally worldwide. We'll, of course, dive a little deeper into the Japan news. Let's also take a look at the European markets map. We're almost at the end of the earnings season. A couple of quirks that we need to look at, including some of the luxury stocks, but also some of the tech stocks and the FTSE gaining 1%. The DAX and the CAC 40 a little bit more subdued, between 0.2 and 0.4% higher. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the EU and the US have barely 6 weeks before the tariff clash triggered by Donald Trump escalates with fresh duties. Now, Brussels says it will accelerate negotiations with Washington to avoid a transatlantic trade war. At the same time, the ECB President Christine Lagarde says Trump's policies offer a prime opportunity to strengthen the euro's international role.
Moments of change can also be moments of opportunity. The ongoing changes create the opening for a global euro moment. And this is a prime opportunity for Europe to take greater control of its own destiny But let's not fool ourselves. It is not a privilege that will be bestowed upon us.
Well, let's discuss all of this with Karen Ward, EMEA Chief Market Strategist at JP Morgan Asset Management. We're also joined by Rosalind Matheson, our EMEA News Director, to discuss the big geopolitical moves. Now, that's also as the German Chancellor, Friedrich Merz, says Ukraine has been given permission to use weapons supplied by its allies to launch strikes deeper into Russia. So thank you both for joining us. Karen, let's start off with you. There's a lot going on, right? There's a lot of news when it comes to Japan, with the finance ministry actually asking things to market participants. But I was struck by the fact that Lagarde says, this is a big moment for Europe, and we want to put euro at the center of it. What are the benefits of actually being a reserve currency?
Well, this is the thing. I always think Europe is actually best in a crisis. It's when nothing's going on. We tend to do bad things, over-regulate, not get deeper union. And I think she's exactly right to say this is the moment, and we will be forced, and we're already seeing that. So in terms of, what needs to happen, we've been talking about things like capital markets union in Europe and how that would benefit the flow of capital. Things like this, I think, will really push those conversations that have been faltering to actually come over the edge. What's the benefit of being a reserve currency? It's access to capital. The US has had the world's capital flowing to it for the last 15 years in abundance. It's been a huge part of why they've been able to grow, why their companies have been able to grow, why governments have been spending a lot more in the US than we have here in Europe. So there are big upsides to having that abundance of capital.
I mean, a lot will depend on the US-EU tariff negotiations, which we'll talk about in a second. But is now the moment to be invested in European markets, or are there too many question marks?
I've been saying since we came into the year, we had a situation where the US was believed to be exceptional, and Donald Trump was going to further exacerbate that exceptionalism. Expectations on the US were too high. Expectations on Europe were too low. And what we're seeing, I think, is people starting to look at Europe again. And I think that this has a lot further to run in answer to your question. Europe is stimulating in all aspects of policy, monetary, fiscal, regulatory, and I think we're underestimating actually how much growth that can unleash. And I keep saying to my clients, stop focusing on the last 15 years. Go back in time. We have had periods where corporate earnings in Europe have been good. I think we've got this perception that Europe structurally can't grow. We're structurally incapable of delivering earnings, and I think that's not right.
Yeah, and Roz, this points to the fact, to see that longer-term success, I think a lot will depend on what the EU can negotiate with Donald Trump. So what are we expecting in terms of tariffs? He's, for the moment, giving 90 days for Europe to see what happens next. And is von der Leyen the right person to negotiate this?
Well, clearly she's got some traction, but maybe also the markets helped ahead of that call with Donald Trump. But they're back at a bit more time to try and negotiate something, and they're talking about fast-tracking talks. We know that there was a call last night, again, between the chief negotiators. That the view is that call went pretty well. So things at least have settled a little bit. The question is, how do you fundamentally get to an agreement when you're so far apart? Because the EU has its red lines here, and the US does too. And interestingly, in all of this, what it's actually been a reminder of, to Karen's point, is that the EU is actually quite a big economy collectively. It's much more serious to deal with in negotiations than, say, getting a trade deal or an agreement with the UK. I mean, it's much bigger, and it's got that heft that comes with it. It has those complications, of course, as well, but it's a much bigger deal, and that's what the US is recognizing. The question is, they're so far apart on everything. Can they maybe pick this apart in ways? Can they say, let's focus on some specific sectors? Can we get traction at least on something? I mean, there's automobiles, there's pharma, there's a lot. Can you pull it apart a tiny bit? Can you look at non-tariff barriers, separate things out? Or do you have to try and get a collective deal in one go, which is much, much harder?
Yeah, and I guess, the biggest concerns for Europe is that a lot of countries have different views, and there's no real figurehead. I know it feels trivial, but Macron was also presenting himself as, one of the big statesmen and leaders. And then we all saw that video of him coming out of, the French plane in Vietnam. I don't know whether that hurts, actually, his credibility on the world stage. I don't know whether Christine Lagarde can fill that void with that, pretty powerful speech she gave yesterday.
Well, as you say, unity is both a benefit and a challenge for the EU, and having leaders all speak with one voice, especially when it comes to Donald Trump. But in fact, you are sort of seeing that. I mean, the new German Chancellor, Friedrich Merz, seemed to be developing his own relationship and perhaps taking things in a different direction, now very much echoing what the rest of the European leaders are. And you say there's always that question of individual benefit versus collective good, and that's the challenge for the EU, and a strength and a weakness. But they do seem to be holding the line here, and they're making very clear they will retaliate against Trump if these tariffs do come on. You know, to your question about Macron, he's in Southeast Asia because Europe is also recognizing, again, you've got to diversify your relationships. And for years, Europe's been trying to find a way to play a role in Southeast Asia. You know, you've got China and the US, Southeast Asia caught in the middle. What's the role of Europe in all of that? So he's there to talk about trade, he's there to talk about mutual defense and so on. There was that video of him coming off the plane. You know, there's been a lot of conversation around that video. His people are saying it was a moment of playfulness. They were having a bit of a joke with each other. You know, whatever you make of it, he's obviously very focused on what's going on in the region. He's about to make a big speech on Friday night at Shangri-La at the summit in Singapore, and where he will probably lay out again what is the path of Europe in Asia, but also, you know, trying to keep people together on Ukraine.
Karen, what do you respond to the naysayers that say, look, Europe is well and good, they'll spend a lot on defense, but actually they just don't have these big companies that will lead the way on AI. So without the Magnificent Seven, Europe will always be lagging the US.
Well, I think it's actually a question whether through the whole course of the year, the Magnificent Seven will be, you know, seen to be such a benefit. One of the interesting things of the long period in which when Europe did outperform was because that was when tech was in the doldrums, and expectations on tech are very high. If we do go through a more challenging period for the tech companies, that might be one of the things that stands in Europe's instead in order of its performance. But I think generally, you know, it's for me, the story in Europe is slightly more about the consumer. We're seeing now real wage growth that we haven't seen for quite some time. You know, our inflation shock was much bigger, much more persistent. And also interest rates still work here in Europe. They don't work anymore in the US. But the ECB, when it took rates up, that hurt. And I think as that gets released, then that's going to bring about a consumer, a domestic small business story. And, you know, we'll see. Defense, you know, there's the whole discussion about whether generating a defense industry has as a side effect, you often get these tech impressive spillovers. So maybe that story comes later. In the short term, for me, it's very much just about a more normal recovery in Europe.
Okay, why do you think interest rate, I guess, cuts don't work in the U.S.? It's very clear that the Fed is trying to say, look, we have these dual mandate, but we're going to focus on inflation a little longer to see where it goes before we cut interest rates.
Yeah, I mean, we're still all too obsessed with interest rates in the US. I think particularly in terms of how it drives growth, what we have learned is that so many US actors, households and businesses are on very long-term fixes. And therefore, when the Fed jacked rates up, didn't really have much of an effect. Whether or not the Fed are taking interest rates down, I don't think would have much of an economic effect either. Fiscal policy is much more powerful than monetary policy, and we forget that. We all spend so much time talking about the central banks, but what's happening on fiscal policy, what's happening in Germany, is much more powerful, at least in the US. Here in Europe, I still think monetary policy works. We're still on those short-term interest rates, so it has been tight. It's taken money out of people's pockets, and that's getting better.
It feels like there's also, you know, a page turner, Roz, when you look at Chancellor Merz, you know, his spending plans for Germany, but also the fact that now he said to Ukraine that they can go further into Russia, I mean, how much of a difference does that make?
Well, there was a lot of attention on those comments yesterday. In fact, it seems like he's now working a little bit to clarify those remarks, because what he was indicating is that all bets are off in terms of Ukraine being able to fire long-range missiles at a variety of targets deep inside Russia. I mean, they're hitting Moscow with drones quite often, but the missiles have some restrictions, including more like border areas for the US, missiles known as ATACMS, the UK allowing a bit further, Germany very cautious about Taurus missiles and sending those to Ukraine at all. So this was quite a moment, but we didn't have the US confirming, we didn't have other countries saying this is true. And today we have the messaging from the German Chancellor, which is actually, he was referring more to the policies that already existed, which is that, yes, there are the opportunities for Ukraine to hit Russia itself with missiles. So it may not be quite a game changer, as we were indicating yesterday. And it shows, again, there's still maybe a level of concern about Ukraine hitting too far into Russia, sites further into Russia with missiles versus drones.
Yeah, and I imagine that complicates things with China on a geopolitical level. And then you look at China from the market's perspective, and they're dealing with, again, tariffs and the stance with the U.S.
Yeah, I mean, I think the situation for me in China is it's abundantly clear the rest of the world, and I do think actually as we proceed through the next 18 months, we'll hear a more protectionist stance from Europe towards China also. We can't cope with this scale of competition. It's hurting U.S. industry, hence we've got Donald Trump. It's hurting European industry as well. So this is a defining moment in China, I think, for them to decide what is their strategy for growth now. Are they really understanding they've got to generate domestic growth? They've got to stand on their own 2 feet. And I think there is a recognition. We've seen some things from Beijing, particularly in terms of behavior towards businesses. You know, we had that obviously big meeting with Jack Ma and other big names in business in China. They're doing a lot to try and begin the process of stimulating the consumer. I'm not seeing the big steps I want to see. We want to see a much bigger consumer-focused stimulus package, a real proper cleanup of the property market in order to sort of put property prices on a firmer footing. But that is what we're looking for in China, this realization, this acceptance that export-driven growth is not an option for the coming decades, and that we need to see that domestic policy.
Such great insights. Thank you both for joining us. That is, of course, Ross Matheson and JP Morgan's Karen Ward on a range of subjects. A very interesting conversation as we try and tie up everything together. Now, coming up, global bonds rally, the dollar rebounds as Japan indicates it's looking to stabilize its debt market after weeks of sell-off. Details ahead, and this is Bloomberg.
Geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
The flood of investment.
Deals were once again on display.
The Saudis are open for business. The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Japanese super long bond yields have been sliding sharply after the finance minister sounded out market participants on appropriate issuance amounts for government debt. Now, meanwhile, the BOJ governor, Kazuo Ueda, signaled his intention to continue raising rates if the economy improves as expected.
To the extent that incoming data allows us to gain more confidence in the baseline scenario, we will adjust the degree of monetary easing as needed to ensure the achievement of the sustainable 2% inflation target.
Well, let's bring in Van Ram, our MLive strategist, for more, and then we'll also speak to Rachel Evans. Van, in some ways, the comments by Ueda seem to be in line with what he said recently. So why the rise in yen?
Morning, Francine. Pleasure to be talking to you. The markets forever live in hope, and yen bulls are a special category. They've been expecting the yen to rally to 115, 120 levels for 2-3 years now. That hasn't happened. So when Ueda reiterated what he's already said many times before, as he was alluding to, the markets, that brief flicker of hope surfaced again and the yen spiked higher. But the important thing, Francine, is that the yen couldn't hold on to those gains. And that is because, the BOJ has been going in fits and starts. They're going at a pretty glacial pace of tightening policy. They're going at once a year, and that is not infusing the markets with any confidence, long-term conviction that the BOJ is going to be able to surmount the inflation problem that they've had. Now, the BOJ has good reasons why they're going slow, why they don't want to make a mistake here, because for decades, the Japanese economy has been without inflationary embers, and now suddenly over the past 3-4 years they've been grappling with inflation, and now the BOJ is thinking, look, with tariffs, with the threat of tariffs looming over Japanese economy, to what extent and how fast they should push ahead. Yeah. And that is why they're dragging their feet, and that unfortunately is showing up in terms of yen losses.
So what can we expect at the next board meeting, then?
Well, I don't think they're going to be raising rates. I think the more interesting bit is going to come from what they're going to revise their bond purchase plan. As you know, long-end yields have spiked in Japan a lot this year, particularly at the 30-year end. We have seen yields explode to the tune of 50 basis points. That's phenomenal, and they don't want to upset that. They don't want the markets to be upset. So I think that the key question for markets will be not whether or not they're going to raise rates. They're not going to raise rates, but what they do with the bond purchase plan going forward.
Ven, thank you so much. Ven Ramdam with, of course, all of the bond yield and some of the yen moves as well. Now, Japan's plans to stabilize its debt markets have led to a global bond rally. The dollar also rebounding, this after a gauge of the currency fell more than 7% this year. We're also joined by Rachel Evans, a senior editor on our EMEA news desk, who for many years is our FX and bonds queen. Rachel, I guess the concern is that, so this is a questionnaire, and markets kind of freaked out. So was there something in the positioning of the markets that, means that the questionnaire was a mistake?
So I think this is all about the context in which this questionnaire came. We've got to remember that we've been seeing a lot of pressure in the Japanese bond market in recent weeks around some of these auctions that have been coming through. And there's just been a sense, that these auctions have not been going as well as expected. And are there really enough buyers of JGBs out there as the BOJ kind of winds back its sort of monetary policy and the number of purchases of bonds that it's been making over recent years? So I think the fact that you have this questionnaire coming at this moment where everyone's kind of really alert to this question of supply versus demand is the crucial point. And the questionnaire itself, doesn't say, hey, we're thinking about, changing our bond supply, what do you think? But it kind of sort of tries to get a sense of what the market conditions are at the moment and kind of how comfortable people are with the volatility. And the sort of sense from the market is that this could be a sort of a forerunner to potentially sort of pulling back on issuance. And that's why we're seeing kind of JGBs getting a boost today and yields coming in.
But that's, basically the potential reduction in JGBs is, a bit of a relief to a global bond market that just has a lot of issuance out there.
Yeah, absolutely. We've been seeing huge amounts of issuance around the world for the last few years. Obviously, we saw a massive spike during COVID where everyone was putting out loads of fiscal stimulus to try and boost their economies. But that hasn't really gone away. We saw sort of that come in slightly, but it's really stuck around. And when you kind of see sort of the plans in Europe, for example, to kind of fund defence, that sense of supply and bonds coming to the market is really still there. And that has been prompting concern globally, right? We've talked a lot about kind of bond vigilantes and how much can kind of governments keep pushing up those borrowings before investors start to say, we need to see more yield in order to take down this debt.
Yeah, is it helping treasuries more than others?
Yeah, so I think treasuries are definitely gaining today. You know, we're seeing kind of big moves at the long end. You're seeing that in Europe as well. And obviously there have been kind of a lot of fiscal concerns that have been kind of weighing on the US picture too. But I think one of the interesting things is you could view, sort of the way in which this questionnaire has come out now as being a little bit of a kind of sop to the bond vigilantes. It's saying, you know, we hear you. And in some ways, you know, if that's a message that investors kind of take away from this, that governments will pay attention to them when they start pushing up yields and start, you know, prompting sort of poor or even failed auctions, maybe that emboldens them and prompts them to get more activist elsewhere.
And Rachel, I mean, some of the other bond markets have basically shifted already to some of, you know, the shorter dated tenors. I mean, is that a global shift?
Yeah, and we've been seeing it as well kind of in terms of sort of the issuance pattern. So investors have been shifting shorter term, but also governments have been. And, you know, the Debt Management Office in the UK, for example, has been kind of skewing its debt issuance towards the shorter end because they're aware that there is more demand in kind of that sort of 2 and 5 year area rather than in the really longer dated side of things. I think that's also partly due to some of the kind of bigger long-term dynamics. You know, we're seeing perhaps fewer purchases from pension funds who have other assets, perhaps in the private space, that they can look at beyond just kind of government bonds.
Rachel, thank you so much. Rachel Evans there with the very latest on Japan. Now, Bloomberg has learned that HSBC has cut more than 24 analysts in recent days as Europe's largest lender deepens a restructuring of its investment banking businesses. Now, sources say the cuts, mostly in Europe, include the departure of Stephen Major, global head of fixed income research. Now, the restructuring aims to increase efficiency and is expected to lead to $1.8 billion in charges over the next 2 years. Well, joining us now is Bloomberg's Stephen Aaron. So, Steve, I mean, this is a big deal also because, Mr. Major was such a big voice in markets globally. But why is the restructuring happening, and why is it happening now?
Right. So I think what's important to see is that this is an ongoing restructuring. This is a manifestation of a plan by the CEO who came in just last year in September and has been trying to cut costs. It's a continuation of that drive. 24 analysts. It's actually, it doesn't sound like a huge number given HSBC is such a massive bank, but they're high paid. It also underlines that HSBC is cutting back in the investment bank. We reported earlier this year that they are cutting the investment bank, especially in Europe and the US. So this is definitely a manifestation of that.
Steve, separately, here in the UK, NatWest is also getting ready to chart its own course without government help. It is very symbolic, but what does it mean for NatWest?
I think it's definitely a significant step, but it is largely symbolic. I mean, the UK government only owns, I think, below 1% in NatWest now, down from over 80% after the bailout 17 years ago. So the last step, which we expect to happen at some point this week probably, or any time, will only be sort of the last final step to push NatWest into independence. Symbolic, but very significant, drawing a line under the bailout era.
Steve, overall, how are banks doing? We focused on HSBC, on the UK. How are the European banks doing?
They're doing pretty well. Stocks are up a lot this year, with especially Italian and Spanish banks benefiting still from sort of higher interest rates, even though they're coming down. Trading activity is doing pretty well. So banks have had a strong start to the year. It's continuing. Even the share prices are back to where they were before the March tariffs. And so, yeah, it's looking pretty good.
Steve, thank you so much. Stephen Aaron's there with the very latest on the banks. Now, to some other news other stories making news today. And Trump Media has jumped pre-market on reports that it plans to raise $3 billion to spend on cryptocurrencies. According to the FT, the move could be announced ahead of a meeting of crypto investors in Las Vegas this week, where the FT reports that Vice President J.D. Vance and Donald Trump and Eric Trump are expected to speak. And you can see pre-market Trump Media gaining 8.9%. Coming up, we'll discuss the UK's green energy ambitions and energy pricing with the founder and chief executive of Octopus Energy. He's Greg Jackson. That's next, and this is Bloomberg.
Right, let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The EU steps up trade talks, saying it will fast-track negotiations with the U.S. and plans to meet Chinese officials early next month. A sharp fall in Japan's super-long bond yields after an unusual move by the finance ministry as it seeks to regain stability. Plus, Germany clarifies its position on Ukraine, using long-range missiles to hit Russia as allies intensify the pressure on Vladimir Putin. Let's get more on that now. We're joined by Greg Sullivan, our Russia economy and government editor. Greg, thank you for joining us. I mean, this took a lot of people by surprise. What is the actual significance of this move by Chancellor Merz, and how much does it likely help Ukraine on the battlefield? Again, I think every country has their pain threshold on how much they'll allow to Ukraine to go into Russia.
That's right. On the face of this, it looked like a pretty significant shift in Germany's position. This has been a long-standing request of Ukraine. Ukraine wants to be able to strike deeply into Russia to degrade that country's ability to attack Ukraine. We're talking about attacking things like weapons storage, oil and fuel depots, airfields. But up until now, Germany has been reluctant to allow that and has also refused to supply its Taurus missiles. So here we have the shift, though Germany did clarify that this has been long-standing, suggesting that maybe it's not quite as significant. Still, it's likely to be seen as a provocation by Russia, which yesterday the Kremlin, we heard that they said that this was dangerous and likely to widen the conflict. But nonetheless, it does align Germany more with the U.S., which has allowed its ATACMS missiles to be used in places like the Kursk corridor region, and the U.K. with their Storm Shadow missiles. Still, questions remain over what supply Ukraine will have to actually use long-range missiles to do these attacks, and whether that impact will be big, given that they're already striking deep inside with drones.
Greg, more broadly, how is NATO actually looking to put more pressure on Russia, and how is the European approach to Russia changing?
Europe has definitely been trying to step up their pressure on Russia, especially after this past weekend, where we had 3 consecutive nights of attacks, including the largest drone barrage of the war so far. We've heard from European leaders that they do want to intensify pressure in a few ways. One, they are considering widening sanctions, including we know that the EU is considering cutting more banks off from the SWIFT financial messaging service. We also know that NATO wants to step up its defense spending. It's starting to take defense more seriously. It's now targeting 5% of GDP as a defense spending target. Of course, some of that would be for infrastructure and non-hard defense. About 1.5% of that would be non-hard, but still that's significantly more than they have been spending and more than the U.S. spends on defense. So clearly, Europe does seem to be recognizing that it needs to be tougher. It needs to put more pressure on Russia because they've been slow walking in the negotiations and up until now haven't really shown that they're quite ready for a ceasefire.
Greg, thank you so much. Greg Sullivan there with the very latest, of course, on NATO, on Russia, on Ukraine. Now, the UK government says it's confident it can meet the goal of having a clean power grid by 2030. Britain is pushing forward with its net zero plans despite clear opposition to green power by Donald Trump. The US president has criticized the UK's approach to North Sea oil and gas, calling Britain's windfall tax on the oil and gas industry a big mistake. Well, we're now joined by Greg Jackson. He's founder and chief executive of UK energy supplier Octopus Energy. Greg, thank you for joining us. I mean, you are de facto one of the biggest voices out there in terms of understanding, the energy flows, how much labor can actually cut bills by, but also renewables. Can labor, first of all, actually lower, bills without a move to zonal pricing? Zonal pricing for international audience is a peculiarly, quirky British, way of calculating prices.
Yeah, well, I mean, first of all, thanks for having me. And in many markets around the world, we've been moving to more and more renewables. The UK is fairly typical. It's about half our electricity is coming from, non-fossil fuel sources. And as we're doing this, what you find is that in one region of the country, it'll be windy or sunny, and in another region, it's not. And so where it's not sunny, we'll be using gas power stations here. Some countries might use coal. And trying to set the price for electricity when you've got this incredibly diverse cost base, wind and solar, high upfront costs, high capital costs, virtually zero marginal cost. Whereas with fossil fuel plants, you've got to pay for the fuel. So as we move into this system, what we're finding is that typically, if you're setting the price for a large market like the whole of the UK, based on traditionally the most expensive unit generated anywhere, it's largely being set by the fossil fuel price. Even though half your power is coming from renewables. Now, many markets have fixed this by introducing some form of locational pricing. In the northeast of the US, you have nodal pricing with 12,000 nodes setting the price based on very precise supply and demand in each region. In Sweden, Norway, Denmark, it's been introduced, and indeed Texas uses it, Australia. All those markets are seeing energy costs on average falling because you can take advantage of renewables. Now in Europe, you've got the UK, you've got Germany, two huge markets that are struggling with the highest electricity costs in the OECD, crippling business, terrible for cost of living, bad for inflation. And so we need radical market reform. That's the way in which, as you build more renewables, you can get cheaper prices, and that's what zonal's about.
But Greg, I mean, I guess the concern is that if this government isn't able to lower the price of energy, full stop, so that our bills are cheaper, then does it put the citizens against renewables because there's no real incentive there?
You couldn't be more right. Look, we did some polling in the UK. 43% of UK voters support net zero. Right. 21% are opposed. So, twice as many are in favour. If energy bills go up, support collapses to 13%. So, if you want to deliver net zero, if you want to deliver clean energy, you have to focus on bringing costs down. And I should say, look, the technology allows this. A unit of electricity generated from wind or solar, typically around the world, is increasing the cheapest unit of electricity. But until we reform the markets, which, by the way, isn't always good for incumbent companies, consumers are not going to see the benefits.
But is the government, is this high on the priority list of the government? Do they understand how important this is to do it also in a timely fashion?
Very often governments feel they have to choose between going forward on a clean energy program or going backward to cut bills. But the reality is, with creative thinking, these technologies, with market reform, with brave action, you can do both. Now, that is on the mind of the government. But look, I started a company 8 or 9 years ago that's going to be very big by disrupting incumbents. And I can tell you, they don't like it. Now, the market reforms that are required will disrupt incumbents, but without them, this mission will be in peril.
But do you think they'll be able to lower prices on bills, full stop? Will they manage?
Market reform in the UK can bring bills down by about $120 per household per year as a baseline. reducing our dependence on the price of gas. By the way, it will also reduce emissions by 18% because you won't need as many coal-fired power stations, gas power stations, to fill the gaps in the wind.
I mean, debt on energy bills is at a record. Is this something that the government needs to tackle?
Well, look, we've just been through a fossil fuel crisis globally, certainly in Europe. So a couple of years ago, the wholesale price of gas increased in the UK 15x, similar in other European countries. We're going to be paying the price for that sometime to come.
Greg, I mean, there's a number of things. You know, the UK may be building a lot of wind farms. Are they building too many? Is there a concern that actually the government has wrong policies or priorities when it comes to renewables?
Yeah, so the UK and indeed some other countries may well be building the wrong, building in the wrong places. So look, at the moment, our biggest offshore wind farm is paid to not generate 71% of the time it could be operating because it's, one end of the country, there's not enough grid capacity to carry the electricity around, so we pay it to turn off. And then we pay gas power stations to turn on. If we're going to build wind power and we're going to benefit from it, we need to build it many locations, closer to where there's grid connections, closer to where there's population. All of these things will help. But we also need to build a bigger interconnected grid. Europe is beginning to join up because, for example, it's always windy somewhere. So if you've got enough interconnections, you can connect the places that are windy right now to the places that are not, and vice versa at other times. There's even very ambitious plans, like, we backed one to build an interconnector between the UK and Morocco, because it's always sunny there, right? So, in this world of clean electricity, we need to reconfigure the system, but we need to do it in the most cost-effective way possible. And that means taking the cheapest energy sources, wind and solar, and distributing them to where that's needed, but at the lowest cost.
So because the U.S. has a bit of a backlash, I think we're kind of greenlash against renewables, again, is there a danger of mismatch of actually the UK going at it alone without the U.S. and then feeling the consequences?
Well, so first of all, we live in a big world, right? And the increasing cheapness, affordability of renewables means that they are absolutely growing exponentially. China last year built 60% of all renewables in the world were built in China. Very rapidly, it's tackling their famous growth in coal plants. It's beginning to reverse that tide. Now, if I look at the US, Texas, not a state known for being particularly,
green friendly.
Woke, yeah, right. It's the one with, I think, the highest proportion of renewables because they're cheapest and you can build stuff there. And the free market capitalist case for renewable energy is stronger every day because these technologies keep getting cheaper. The cost of batteries has fallen 93% in the last 13 years. So grid-scale batteries that you need to help balance the renewable system are getting cheaper. Electric vehicles, despite some of the kind of stuff you'll see in the press, are now 25% sales in the UK, around 20% in Europe, and they're growing rapidly. Each one of those has got a battery that will hold enough power for a typical European house for the best part of a week. So this system is growing around us. If we try and resist it, it will just cost more. Look, I don't know about you, but if you're crossing a multi-lane highway, the worst place to stop is in between, right in the middle, right?
Yeah, you can't stop, full stop, just because it feels a bit tricky. Greg, when you look at AI and data centers, I mean, this is like the big challenge we're going forward just because we need so much of the energy. Are small modular reactors right to power those?
I mean, they could be. At the moment, though, we're years away from the first ones coming online. We don't really know whether they're going to deliver. I hope they do. Yeah. But first of all, we saw with DeepSeek, which maybe uses 20 times less electricity than previous large language models. The opportunity to make AI much more energy efficient is huge. We don't know where that's going to go. So we definitely need more electricity for it. But it's far too early to call. And I think there's already some of the projects that were kind of being built on the back of AI demand, are being held for a bit. I think the second thing about, the sort of AI world is we don't yet know whether they can use energy more flexibly. Right. You can locate a large language model, a sort of an AI learning data center pretty much anywhere. So in the US, you're seeing them being built in the areas with the most abundant cheap electricity, by the way, which is typically renewable.
So interesting, Greg. Thank you so much. Don't be a stranger. You have to come back to give us updates on all of your projects and what, of course, the UK government is doing. Greg Jackson, their founder and chief executive of Octopus Energy. Now, European car sales dropping in April amid weaker economic growth and uncertainty due to global trade tensions. That prompted consumers to hold off on larger purchases. Well, Bloomberg's Oliver Crook joins us now. So, Ollie, break down the numbers for us.
Yeah, so listen, it's probably not a total shock that the sort of month that a global trade war is launched is when people are not feeling terribly inclined to buy new cars, and that's really what we saw overall in the month of April. I'll break it down by regions first. When you look at the sort of broader Europe, this will include the UK and sort of outside of the EU, sales were down by 0.3%. However, if you were to strip some of those out, the UK down, for example, was down 10%. If you strip that out, the EU actually sold 1.3% in terms of growth there. France was down about 5%, and Germany was basically flat. So that's the overall picture. When you look at the actual engine types, this is always interesting to me to see what kind of cars are actually being sold. When you look at gas and diesel, that was actually down 22% in terms of the sales for the month of April. Hybrids were up 17%. This was really the sweet spot for a number of months in Europe where hybrids were really doing very well. But now EVs up 28% in the month of April and making up 17% of the total market share of all of the cars that were sold in the month of April across Europe. What is interesting, when we drill down into the individual brands, and we could talk about a lot of them, really the standout here has got to be Tesla. We've had Elon Musk, as we know, very active part of the Trump administration, very vocal on some European issues. We wonder if that may have something to do with the fact that sales in April for Tesla were down about 49% year on year, down 50% year-to-date sales, down 39%, and their market share in April, 0.7%. Francine, a year ago, Tesla was holding almost twice that, 1.4 or 1.3% market share in all of Europe, and that includes even combustion engine cars. So Tesla getting absolutely crushed when you look across the European market, and that is something we've seen consistently for the last few months for Tesla.
Latest, of course, on the European car sales. Now, coming up, we'll be joined by Adam Posen, former Bank of England MPC member, to discuss his outlook for the global economy in light of the U.S. trade war. That's next, and this is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
China's government is considering a new version of its Made in China campaign to boost production of high-end goods, prioritizing technology, including chip-making equipment. Let's go straight to our China economy and government editor, Alan Wong. Alan, what is China planning with this new manufacturing blueprint?
We've learned that China is planning to come up with a new version of its Made in China 2025 plan, focused on advancing China's capabilities in advanced manufacturing. The focus will be on the equipment used in the making of semiconductors, the most advanced kind. Those of you who've been following might remember that back in 2015, the Made in China 2025 plan said that China would want to create a great capacity in building the most advanced kind of machine that makes the most cutting edge of chips, the kinds that we use in our iPhones. But that's one of the rare goals in the original plan that fell short, whereas other areas such as solar panels, batteries, and EVs, China exceeded their original goals. And this is significant because China shows that it is intent on pushing for its manufacturing edge, even though the US and EU have complained about imbalances with the Chinese economy.
Yeah.
And this shows that China is continuing to see manufacturing as a key aspect of its economy, but also that China is hoping to safeguard its economic security because it sees advanced manufacturing as a key part of the future of economies. And by having the domestic capacity to build high-tech products, China is also trying to prevent the U.S. from cutting off its access to those kinds of technologies that make up the future economic growth.
Alan, thank you so much. Alan Wong there with the very latest on China. Now, we're now also joined by Adam Posen, president of the Peterson Institute for International Economics, an independent nonprofit research organization based in Washington. Of course, you all know him as a former member of the Bank of England's Monetary Policy Committee. Adam, as always, thank you so much for joining us. Now, we want to talk about China, we want to talk about the UK and the US, but it feels like the global economy is going through a massive shift.
Yeah.
And frankly, I don't really know where it ends up. Do you?
I have an approximation. Thank you for having me, Francine. I think there's quite an understandable amount of pressure to focus on the day-to-day because so much is happening, and obviously there's money to be made day-to-day. And some of the governments, notably the Trump administration, are also trying to capture the day-to-day. But if you think about it, what's really happened is we've had a regime shift. The U.S. has decentered itself. I started warning about this, you and I talked about this a few years ago, about the post-American global economy. It's now here. And what that means is that the U.S. is behaving more unilateral, which it always was, but it's creating an air of uncertainty over the whole economy. And from a financial perspective, a lot of things that used to have zero risk weight, like treasuries, no longer have zero risk weight. And so there's a cascade of effects that comes out of that.
But is it, an economy that's rebalancing, or could it actually be out of kilt?
No. The rebalancing concept was always nonsense. It didn't mean anything because, in the end, no matter what Secretary of President Trump says, there was nothing to rebalance. So the issue is, are they becoming on an unsustainable debt path?
Yeah.
And we had to go more austere after Biden left us with such large deficits, and the Republican Congress and the president are going in the opposite direction. So we're heading towards unsustainability.
Yeah, and we're seeing it today, actually. There was a big, Japan move that basically repriced treasuries. So there's something, the market is feeling it, but I don't know whether, there would be a big credit event. So a treasury auction that goes badly. When do you see it culminating?
I don't know. I mean, obviously the odds are worse going forward. We do have a couple things going for us that post-2008 and especially roughly 2014, we've got much more solid fundamentals in the financial system. There's the unknowns about the private credit market, but except for that, most people's balance sheets, most people's liquidity is much better. So there is resilience in the system. But this is a fundamental repricing. I think that's right. If we're lucky, it's a step down.
Yeah.
It's not an ongoing repricing.
Does the U.S. dollar as a reserve currency stay, or Lagarde was talking about the euro's big chance?
Yeah, no, I think it's right for President Lagarde to say that. Maybe not in the tone she's taking, but certainly, I mean. The way to think of it is the dollar remains a reserve currency in the sense that we can still fund U.S. treasuries in dollars. And in an emergency, you may have to play a little bit with the interest rate, but you can get funded. But what Lagarde is onto, and which she's right to be onto, is the dollar is becoming less central. That it can't be the sole. You have to have some amount of hedging against dollar assets, which you never used to do.
I mean, one of I think the biggest questions is also what's happening to inflation.
Yeah.
So we know that, Fed governors are worried about inflation picking up all of a sudden, which is why they're probably hesitant to cut interest rates, but it's not showing up in the data yet.
That's true. And I think the Fed, it's like the analogy of the goalkeeper, in a penalty, has to dive right or dive left. And the goalkeeper right now is trying to stay in the middle. But I think they're going to have to dive towards inflation rather than towards recession. It's not there in the data yet, but it's there in some of the expectations moves.
Yeah.
And the issue's never been so much what happens initially due to the tariffs. It's about what gets passed on, what gets followed through in the system. And that's where I think people are overconfident.
But so why is it happening?
Why is it delayed, or why is it?
Why is it delayed, and why are people overconfident?
I think it's delayed because it goes with the fact that we live in a world of low inventories.
No.
Everybody moved to the Toyota system to some degree. And so until we work through and get the next batch of inventories, the prices aren't felt. I think there's also a sense of uncertainty, too much uncertainty, that the tariffs aren't going to remain, particularly vis-a-vis China. And so people are waiting. But the fact is, I think we're pretty much where the tariffs are going to be. So then you'll start to feel it coming through.
Adam, what do you do with China right now? And again, in this, everything's a bit muddled. Geopolitics, economics, like market moves. And China's a massive player in this that often gets forgotten.
It gets forgotten, obviously shouldn't be. But on the other hand, China is in a position where it can play things slowly. The really cynical is the old saying of when your enemy's making a mistake, don't interfere. The U.S. is doing so many self-destructive things. But I think the point is China remains, as your reporter was just talking about, it's concerned with self-sufficiency, which is always a mistake, but it's also still got to clean up its own internal messes. China, like the U.S., is mostly a domestic economy.
We're going around the world because I don't speak to you very often in London. And is it, we know that the spending from Germany is a big game changer.
Yeah.
But are we expecting too much of it? Because it'll take a long time to trickle through.
I think we're expecting probably too much in terms of the short-term forecast, Francine. It's not going to be a huge stimulus right now. But I do think it is, along with the moves of some of the Nordics, Netherlands, Denmark, some of the other countries in Europe, Poland, I do think it is a smaller but real step change for Europe. And this is why Lagarde's comments on the euro are timed well, because this is part of a meaningful shift towards European integration, European functionality. And that does make the euro more relatively attractive long term.
But Europe away from the U.S., closer to China or closer? Where do they find? Europe is not big enough to sustain alone.
Yes,
right?
it is. Yes, it is. I think that's the issue for Germany. Of course, is do you, like China, do you become more of a domestically driven, less of an export-dependent economy? And that challenge is real. But Europe as a whole is a viable economic bloc, and it can trade with the rest of the world. If the U.S. and China are bullying the rest of the world and putting geopolitical conditions on their trade, Europe, and I was arguing this in the Tommaso Padoa lecture at the Brussels Economic Forum last week. Europe can lean into being its best self and say, okay, you don't want Chinese students, we'll take Chinese students. Okay, you don't want exports from Africa, we'll take exports from Africa. And it can gain, and it can make deals. Europe's going to be in a good position if it plays it right.
So interesting. Adam, thank you so much. Always too short of time.
Thank you for having me.
For a longer walk next time. Adam Posen, president of the Peterson Institute for International Economics. Now, Lynn Martin, the president of the New York Stock Exchange, is on surveillance at 1 p.m. London time. I know they'll talk a little bit about markets and, of course, what's been happening in Japan. Up next, Bloomberg Brief. This is Bloomberg.
Our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Calming nerves, Japanese authorities step in to ease bond market gyrations, setting off a global rally. Pedal to the metal futures rally as the EU agrees to fast-track trade negotiations after President Trump extends the deadline. And BYD beats Tesla. The Chinese EV maker sells more cars in Europe than its American rival for the first time ever. It is a rally underway after your long weekend. Hopefully you got your rest in because no respite for the weary. We're up 1.4% for your S&P. NASDAQ 1 futures up 1.6%. We are back around to a round trip as to where we were before Trump threatened the EU with the 50% tariff. Is this a market that's dealing with some fear fatigue? Of course, President Trump backed off of that, but a rally underway. A rally also in the bond market. This is due to something different. Japanese authorities will get into this in just a moment, talking about trimming back their issuance. So if you look at what Japanese yields are doing, they're down 17 basis points. That's the biggest move since the April 2nd Liberation Day, and it's having ramifications across global bonds. German yields are lower this morning too. Your U.S. 10-year yield down about 5 basis points. That's your overall markets this morning. Let's get some stocks to watch with. That is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So we're starting off with a bit of M&A in the data world in software. We're seeing news that Salesforce looking to do a takeover potentially of Informatica. That could be worth up to $7 billion. And we are seeing Informatica rising around 10% at the moment. Salesforce edging up in the pre-market as well today. Then we've got DJT, the social media company owned by Donald Trump. Of course, that one gaining as the company said to be looking to be doing a share placing aimed at buying a load of cryptocurrencies, potentially around $3 billion worth, according to our reporting. Trump Media and Technology gaining around 12% in the pre-market this morning. And then finally, US Steel up once again. This is a second day of gains after Trump announced the partnership with the company and Nippon. kind of unclear whether this will be a takeover or a bit of an investment. We are seeing US Steel gaining around 2%. Jefferies is cutting the rating on that one today, thinking that the gains might be overdone. As usual, these are all available on our fantastic Before the Bell opening wrap on the terminal this morning, Danny.
Who would have thought we'd finally get a conclusion to this deal? Joe, thank you so much for covering that for us. We'll catch up with you later in the hour. That is Bloomberg's Joe Easton. Also in this hour, in just moments, Kit Jukes of SocGen will be joining us. Later, we'll also catch up with Rob Casey of Signal Global Advisors as EU negotiations continue on. Now, I mentioned this. Japanese government bond yields are dropping as speculations mount that the finance ministry could tweak its debt issuance. Joining us now is Bloomberg's Rachel Evans. Rachel, what has been the reporting on Japanese authorities this morning?
Yeah, so we've been hearing that we've had a survey going out to Japanese bond traders and bond investors about issuance and about the type of supply that is working for them and the type of supply that's not working for them. Obviously, the context to this is that we've seen a sell-off in Japanese bonds in recent weeks. We saw some very poor auctions coming through there. So there's a lot of angst about whether there's really a mismatch in the supply and demand within Japan's bond market at the moment. As the Bank of Japan kind of pulls back on its bond buying program, are there enough people to kind of step in and take up the slack? So this questionnaire kind of comes at a time when those questions are all floating around and really seeks to kind of get input from the bond market participants as to sort of how they feel about recent volatility, how they feel about recent supply. And people are really viewing it as kind of like the beginnings of maybe a conversation about possibly pulling back on supply, which is why we're kind of seeing yields falling so significantly today.
Right, and it comes only just about this time last week when we had that horrible 20-year auction in Japan that seemed to kickstart some of the losses in the bond market. Rachel, it's not just the Ministry of Finance we've heard rumblings from. It's the Bank of Japan as well that initially led to gains in the yen. Could hikes be coming for the Bank of Japan?
Yes, but very, very slowly, I think, is the answer to that. We've been seeing that the Bank of Japan really moving very carefully as it seeks to raise rates. We're not seeing kind of, necessarily any sense that we're going to see the Bank of Japan accelerate. But, we saw Ueda come out again today and talk about sort of the slow progress towards inflation. And that does suggest that we are going to see that kind of path of hikes continue in coming months. At the moment, it seems unlikely that we'll see anything sort of prior to kind of September or towards the back end of the year. But that's certainly kind of what prompted people to start kind of thinking about the yen again more closely from that perspective.
Rachel, thank you so much for joining us this morning. That is Bloomberg's Rachel Evans. Joining us now, I'm pleased to say, is Kit Jukes, Chief FX Strategist at SocGen. And Kit, quickly the reporting from the MOF, quickly taking the wind out of the yen sails when it comes to possibly pulling back on bond auction issuance. But is this just the beginning of necessary action from policymakers with gyrations that, let's be honest, are also coming out of the U.S. with the issuance likely coming from there?
Yeah, look, I think that if you have a perception as a debt issuer that the long end of the curve is not popular and the depth of demand isn't there, why waste money by borrowing expensive money? If there's a structural issue of we're nervous about inflation and things like that, if you're a central bank, you tell your debt office, back us, we'll have inflation under control over the medium term, and these yields, these rates we have now won't last forever, and you pull away. And then you have structural things like we have, for example, in the UK, where the pension industry has changed and the demand's not the same. So it just makes sense to me not to keep on trying to sell bonds that people don't want and to focus selling parts of the maturity spectrum that actually there are buyers for, and then it calms it down.
But when it comes to the driver of this market, Kit, how much over the past week do you see coming from places like Japan, of people wanting to put their money in other assets, in other markets versus what's happening in the U.S.? Is it the U.S. that's in the driving seat right now?
The U.S. drives the market in the sense that it's driving the economic piece. The tariff policies are driving the global economy and sentiment about it. But we're in a sort of a dead zone where there are not imports arriving at U.S. ports on the West Coast that are going to have to pay high tariffs yet, and that are going to go into consumers, and we're going to see the reaction. We're not seeing that. So we're trying to work out where we are without much useful information. And in the meantime, we're watching markets. What we find is they're hyper correlated. So if one long end sells off, you can't work out exactly which bit started it, but they all do. And we try to work out what that means in turn. So, yeah, what we found out is that the global markets are still very joined up. That's not a big surprise. What we're trying to do at the moment is, for example, in the foreign exchange market, is figure out whether we get another move soon or whether we're just going to have to wait for economic news over the summer that tells us where we are. And you get a sense a bit, dollar yen, 140 something, euro dollar in a range, very choppy, very reactive, but not necessarily going anywhere.
Kit, we might be waiting for some time. Some Fed policymakers have said it's something like a timeline of September when the data will finally start to make sense. What does that mean in terms of the dollar, where it goes? Because one could argue that the dollar isn't weakening more because there has been some strength in the economic data. How much of that is a pull forward and will result in real weakness, maybe once the data catches up?
Well, again, the dumb answer is it'll depend on the data. But yes, right now, everybody was very quick to revise down their U.S. growth forecasts. So that's done, and now they're creeping higher, and the dollar looks, it looks a little bit oversold on the now data. But we don't know, and I think that's going to be the big test. If the U.S. economy breezes through the arrival of more expensive imports and just powers on, then the dollar's too cheap. That just seems unlikely, frankly. But we at the moment we're just kind of figured out. I do think in that sense, though, I think it means euro dollar and dollar yen in particular are going to be in ranges. Some of the other currencies we might have different stories for.
We also have a positive fiscal impulse, too, coming from the American budget coming out. Kate, usually you get more borrowing, more spending, wider deficits. That money shows up in corporate profits, higher stock markets, and often that means foreign money flows into the U.S. and a stronger dollar. Do you expect that to still be the case this time with the budget going through Washington?
As it gets through, we've seen, obviously, the downgrade didn't really matter at all, but there is concern about the direction of U.S. fiscal policy in markets. That's a source of some nervousness. And if that concern translates into not just higher, really long-dated bonds, but higher bonds along the curve, then it's going to be problematic. But in the normal course of events, it means that, for the sake of argument, 5-year yields are higher in the US. They have a different fiscal monetary policy than others. I mean, the same is happening everywhere else, and that's part of the challenge. The Europeans are easing fiscal policy. If the Japanese adopt fiscal policy that's easier and the Chinese do, then the big danger is that we've got a shortage of global savings relative to all this debt arriving, and then I'm not sure I would want to be the biggest borrower in the world.
Yeah, fair enough. I mean, you have to put that money somewhere, though, Kit. I mean, do you buy this narrative that there could be a foreign buyer strike in the bond market or not? So if, again, most global bond markets are dealing with a similar issue.
No, I just think that price discovery, if you like, is going to take real yields to be higher. The term premium will build itself back in. I think my concern is back in the foreign exchange market, where you've got to start off with, at the beginning of this year, foreign investors had $62 trillion worth of U.S. assets. Do they want to grow that number is the question I don't know the answer to, but it does seem to me that that's what everyone's now aware of. We are all very long U.S. assets overall.
I guess the question, though, Kit, is it just a readjustment of that, or is it a new framework we're dealing with? George Saravelis, for example, over at Deutsche Bank, has started to talk about a dollar frown, that at one point, at one side, you have too much fiscal easing, the other side, you have too much fiscal tightening, and both result in a weaker dollar. Is it a new framework, or is it just a readjustment of too much exposure to U.S. assets?
I think it's just a bit of a readjustment, a bit of a kind of, looking in the mirror and am I comfortable with the amount of dollar assets that I have? But I think more than anything else, it's uncertainty. This is politically driven in the sense that these are big political changes and the market is unsure about where it goes and investors are unsure. And at that point, the dollar is vulnerable just from people saying, hang on, until I know how all this tariff stuff plays out for the U.S. economy, for inflation, for growth, for the global economy, I think I need a defensive positioning. And if I'm a German investor, why wouldn't I bring some money home into the German bond market, which is offering much higher yields than it has been for years?
Kit, truly one of the best. Thank you so much for joining us this morning. That is SocGen's Kit Jukes. Let's now get some other top stories that are trending on the terminal this morning. HSBC has laid off over 24 analysts in recent days. That includes their global head of fixed income. Bloomberg sources say most of the cuts were in Europe. The move is the latest in a process of restructuring and streamlining that began when the CEO took the helm last September. Dutch pension fund PME is issuing a blanket warning to U.S. money managers: don't cave into pressure from the Trump administration. The $65 billion fund is concerned that the president's handling of issues like climate change and demolishing the judiciary aren't being condemned by firms. PME is the latest European pension fund to review or rescind its mandates with firms like BlackRock and State Street. European auto sales dipped 0.3% last month, led by a decline in demand for gasoline and diesel cars. Global trade uncertainty has also been prompting consumers to hold off on larger purchases. Sales in EVs rose 28% last month, but still make up a smaller share of the market that some analysts had anticipated. Coming up, trade talks accelerate. The EU is ready to negotiate with the U.S. as President Trump delays the 50% tariff deadline. We'll discuss that next, coming up on your Bloomberg Brief.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Earnings season is here.
Earnings, the hot topic of conversation. It's going to be a lot of fireworks.
Pretty astonishing moment in time in the earnings context.
Bloomberg is first to break the numbers.
Goldman Sachs, JP Morgan, Morgan Stanley.
Booking, Airbnb.
Meta, Microsoft, Qualcomm.
There's a lot to talk about here.
With the smartest insights.
We're not seeing dramatic weakness.
It has been an incredible period of time from a trading perspective.
We feel really good about the market share trajectory.
Continuing coverage on Bloomberg. Context changes everything.
Nice call, and I agreed to move it. I believe June 9th would be, July 9th would be the date. That was the date she requested. Could we move it from June 1st to July 9th? And I agreed to do that. And that she said we will rapidly get together and see if we can work something out.
President Trump has agreed to extend the EU tariff deadline after speaking with European Commission President Ursula von der Leyen over the weekend. Now the bloc is prepared to accelerate talks. The EU spokesperson responded to the move saying, quote, "There is now a new impetus for the negotiations. They agreed both to fast-track the trade negotiations and to stay in close contact." Joining us now is Bloomberg's Brendan Murray. Brendan, what does that even mean, to fast-track negotiations?
Well, it means that they're going to get on track and they're going to start talking about specific issues. This time last week, these talks were going nowhere. They were exchanging proposals, rejecting each other's ideas for how to get these negotiations going. But we've got now a 6-week sprint to try to do a deal in the world's largest trade and investment relationship. It's going to be a real short amount of time to get a lot of work done. I think we could expect something incremental to get done on some of the key issues like tariffs and non-tariff barriers, the steel and aluminum tariffs that the U.S. is imposing. But there's a whole lot of work to get done. But I think the key word for President Trump was speed. He thought the EU was dragging its feet, and von der Leyen, it seems, was able to communicate the message over the weekend that they're ready to move fast.
Well, trying to do this fast, Brendan, had always been part of a problem too, though, because it's not just the EU they're talking to. The start of July also comes with the deadline of all the other reciprocal tariffs, not to mention China's pause too. How's the administration going to get all of that done?
Yeah, I mean, and the EU is a particularly complicated one because all 27 nations of the European Union have to be on board, so there has to be a lot of back and forth internally, Brussels to the other capitals in Europe. And as you suggested, there are negotiations that are even further along with countries like India, South Korea, and Japan. Thailand is in there with its talks going on. So, and then of course China. China's on a separate deadline, a separate 90-day period that ends August 14th. And so we'll see if the Trump administration can juggle all these things and deliver something substantive in the next 6 to 8 weeks.
Well, Brendan, when these negotiations first started, or after Liberation Day, there seemed to be a real willingness from the Trump administration to put on tariffs that not just punish global economies, but punish the U.S. economy too. Instead, what we've gotten is Trump backtracking or giving pauses for various nations. How does that color negotiations at this moment?
Yeah, you would think that, well, we're starting to see a pattern, basically. He starts out with, the reciprocal tariffs, talks don't go anywhere. Then he takes those tariffs to an extreme level. Those create some momentum for talks. He pulls back, and he sees where they can go from here. I mean, the bottom line is that the world is looking at a 10% universal tariff into the U.S. market, and all these other numbers that are being thrown around, the 50% for Europe, the 145% for China, they're going to look pretty. They're still going to wind up with something on the order of a 10% tariff on U.S. goods. It depends. They'll negotiate the fine print in the next several weeks, but it seems pretty clear that the Trump administration has established that 10% as the floor that's not up for negotiation.
Brendan, thank you so much, as always, for your coverage. That is Bloomberg's Brendan Murray. And I should mention, U.S. futures now back around to the levels that they were at before that threat from President Trump of an EU 50% tariff. We're up 1.5% on your S&P 500 futures, a market that's perhaps more accustomed and now partially assume that full threats won't materialize from the Trump administration. Coming up, we're going to take a look at what else is making headlines around the world, including the introduction of checked bag fees at Southwest Airlines. We finally have the price on what that will cost you. This is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
A stagflationary shock, if Jamie Dimon is correct, pushes up inflation, pushes down economic activity. But our monetary policy instruments either push up economic activity and inflation or push them both down at the same time. And that's a particularly challenging environment for policymakers to navigate. And that's why so many of my colleagues and I are saying we're really in a wait-and-see mode.
The Minneapolis Fed president there, Neil Kashkari, saying something we've heard time and time again from Fed speakers as of late. That is cautiousness and keeping things as are in the face of uncertainty around tariffs. All right, let's get you some front page news and look at what's making headlines. First up, the Wall Street Journal on the front page over there reporting that Southwest Airlines will start charging for checked luggage. This is something we already know, but we finally have the cost for you. The first checked bag will cost flyers $35. A second will face a further $45 fee. Something that had concerned a lot of people, considering they used to not do that. All right, and the New York Times reporting on this, a tragedy in England. Nearly 50 people were injured after an unnamed 53-year-old driver slammed a car into a crowd celebrating Liverpool's championship victory. We wish the best for all of those affected. Next, the Financial Times leads with the EU's plans for a sweeping stress test of non-banks. Regulators are going to look for vulnerabilities in the financial system due to fears over the rapid growth of hedge funds and private equity. All right, a quick check on your markets this morning, because we are in the midst of a rally for your S&P 500 futures. Those are up 1.5%. Again, we've come round trip. We're back at the levels that we were before President Trump threatened a 50% euro tariff on the EU, 50% tariffs rather. The Bloomberg Dollar Index, that is higher, and your 10-year yield's down by 4.5%. That move being led by Japan. And the MOF reportedly considering trimming back some of its issuance. Now, coming up, we're going to be catching up with Rob Casey of Signum Global Advisors on his low hopes for a U.S.-EU trade deal after we did indeed get a pause in that. Will we get negotiations with so much to be figured out before early July deadlines? All of that coming up on your Bloomberg Brief. You're watching Bloomberg TV.
at Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, you know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Calming nerves, Japanese authorities move to ease bond market gyrations, setting off a global rally. Pedal to the metal futures rally as the EU agrees to fast-track negotiations after President Trump extends the tariff deadline. And BYD beats Tesla. The Chinese EV maker sells more cars in Europe than its American rival for the first time. Well, another delay. We had a call between Trump and von der Leyen on Sunday. Futures back to where they were before Trump threatened a 50% tariff in the EU. We're down just under 1.5% for your S&P 500 future sessions. Elsewhere, the bond market is also rallying this morning. Authorities in Tokyo biting the bullet, acting to calm the nerves of investors. The reports at the Ministry of Finance is sounding out, trimming its issuance, putting out surveys. That after this point last week, the 20-year auction went so poorly in Japan, so yields down across the board, down 17 basis points for your Japanese 20-year yield, about 5 basis points for your 10-year yield at 4.46 this morning. Those are your overall markets. Let's look at the stocks to watch. Here's Bloomberg's Joe Easton with what's on the move. Good morning, Joe.
Hey, Danny. So we're starting off with a bit of M&A in the data and AI space. We're seeing news that Salesforce could potentially come in and buy Informatica. That could be worth around $6.8 billion, according to latest report. Bear in mind, there was reports around a year ago of a deal coming through, almost double the size of that in terms of the valuation. So some people might potentially not be too pleased about this latest news today. Then we've got Donald Trump's media company in focus as well, looking to potentially do a share placing and raising around $3 billion worth of cash to spend on cryptocurrencies. There is a big event going on over in Vegas, a crypto event. That's the place to be at the moment. But that stock up around 13% in the pre-market. And then finally, Stellantis in the car space. This is gaining, catching up after we all had a day off yesterday. That is on news of Trump delaying that potential 50% tariff, as you were discussing a moment ago there, Danny. So we are seeing Stellantis up around 7%, even surprising me in terms of that move there. Keep an eye on Stellantis and the other automakers this morning, Danny.
Joe, excellent work this morning. That is Bloomberg's Joe Easton. And speaking of that, the U.S. and EU are looking to fast-track trade negotiations after the tariff pause from President Trump. Rob Casey of Signum, though, is not keeping his hopes too high on a potential trade deal, writing, quote, "We remain pessimistic regarding a potential U.S.-EU trade deal as the sticking points remain, in our view, too numerous and too significant to overcome." I'm pleased to say that Rob joins us now. He's senior analyst at Signum Global Advisors. Rob, the market is quite optimistic that we got this pause, so a little bit of different tone there. Why do you see a deal deal is unlikely.
Well, I think it is good news that we've got the pause over the weekend, right? We actually, my colleagues Andrew Bishop and Nico Fitzroy published a note on Friday morning, feels like a lot longer ago than that, to say that we didn't expect that this 50% to come into place on June 1st, for the most part because it was too big and too fast, right? So we did see it as both a carrot and a stick for Europe to come to the negotiating table. The issue from here is, even though there is, I think optimism around mood music and desire to get to a trade deal, the things that they're negotiating, Donald Trump does not appear willing to budge, and Europe certainly isn't and can't budge in the short term, right? These are things like the carbon border adjustment, things like VAT, right? They are institutional and important and entrenched in the European system. They're not, just things that can be raised or lowered at will.
So then what takes its place? If you can't have any sort of negotiation, if there's not any movement, what does the trade relationship between the U.S. and Europe look like?
Well, I think what the market may be reacting to in a positive sense today is not just that the U.S. and EU are going to get to a trade deal in the short term. Again, we think they won't, but rather that President Trump is going to continue to delay, right? And we've seen that throughout the course of his second term. He will make significant threats, and there was an argument, I think, in his first term and into his second that you take him at his word, right? The threats that he makes are what he's going to follow through on. I think we've seen since then, certainly since the beginning of his second term, that's not always the case.
Well, especially on that, if you are to negotiate the whole art of the deal, the idea being that you are willing to shoot the proverbial hostage, in this case being the American economy and markets, if Trump isn't willing to do that, how does it color negotiations from here? How do other nations approach the U.S. with full knowledge that Trump keeps reversing?
Well, I think, frankly, it makes negotiations harder for the Trump administration, right? Because if you're Ursula von der Leyen, if you're South Korea or India, countries that and blocs that Trump is really pressuring to get to trade deals, you kind of say to yourself, we're willing to give on X, Y, and Z, but the truth of the matter is we don't believe that Trump is going to follow through on all of his threats. Now, the thing is, we get to early July, and President Trump is going to have to show the American people something, right? He's either going to have to show them deals, or he's going to have to ramp tariffs back up. And so to that extent, I think markets are maybe a little bit too optimistic going into July. If we get to early July, without any of these deals, I think President Trump is going to have to, take some skulls.
To that point, what do you expect early July to look like? Because there are a lot of deals. The only thing we have is an agreement of sorts with the UK. We're still waiting on Japan. The EU, to your point, still looks far off. So what are we likely to get in about a month's time?
I think we're likely to get a resumption of at least some tariffs. And it's because if we get to early July and President Trump has not gotten the deals, the bilateral deals that he wants, he has two choices, right? He can punt further, and I think that really demonstrates to other countries that he doesn't have a whole lot of leverage, or he can bring tariffs back on. And that's not to say that it'll be a brave new world and those tariffs will stick forever, right? But there has to be some stick for countries to come to the table with the U.S., and even for those countries that are already at the table for the U.S. to actually get a deal done, right? If we get into the middle of July, Trump isn't willing to offer many carrots, and if the stick sort of evaporates, then he's not left with a lot of leverage.
So one thing you are more confident on, fair to say, is the big, beautiful bill passing by summertime.
Yes. We now think, for full transparency, we were pretty skeptical that the House would be able to have as much progress as they did, into last week, right? It's now through the House. I think, importantly, it's through the House with a framework that looks pretty good to most senators. Now, the truth of the matter is, in our bicameral system, the Senate certainly sees itself as being superior to the House. They're going to want to put their fingerprints on the bill. They're going to want, the right of authorship is what they say. That being said, I don't think that the changes that we are going to see from the House into the Senate are going to be so significant that it, essentially the process breaks down, right? I think the Senate will make some tweaks. President Trump will push them to make narrow tweaks, small tweaks. He said he's fine with changes, right? But I think he's only fine with changes that the House can then, repass through, and he'll be able to sign by the August recess. July 4th is optimistic. It's an aggressive deadline, but I think certainly by the August recess, Congress will come together. The Senate and the House, of course, not with any Democrats on board, but Republicans will come together and get it done.
But there still seems no impulse to sort of rein in any of the fiscal deficits, any of the fiscal trajectory that we are in. Is there any mechanism to do that, or is this set in stone? Are we on the path we're going on right now?
I think we're on the path we're going on. There are a couple of senators who Ron Johnson in particular, have said, there aren't enough spending cuts, that the fiscal impact of the bill is too negative for them, right? they're probably not a blocking majority in the Senate. There are 2, maybe 3 senators on the Republican side who feel as though this bill doesn't work as it is currently written. If we were going to see more stringent fiscal measures, we would have seen them in the first House bill. And so at this point, I think, you know, we're proceeding forward as is. And there are certainly some concerns by Republicans in Congress, but when President Trump tells them to pass a bill, you know, unlike tariffs, which we've seen he's willing to pause on, he's not really willing to pause when it comes to pressure on Congress, and they generally do what he says.
If we do indeed get this bill passed, which again, all signs pointing towards this, George Servis of Deutsche Bank has been writing about this idea that we've become locked in, that just because of potential changes in the midterm, because of the difficulty of reconciliation, that what we get now is law basically for the next decade. Do you think that's fair, that we have to worry about this fiscal debt trajectory for the next decade and whatever the outcome of the passage of this bill is?
Yeah, it's a really interesting point and a really interesting question. I wouldn't go so far as to say we are locked in, but I think we have a two-party system, and neither party is willing to take the deficit seriously. So from a legislative perspective, are we locked in? I would say probably not. As we get more polarized, we will have, you know, more trifectas, right? Come 2028, it's not out of the question that we'll have Democrats across the board, right? Maybe we have Republicans again, but I think more likely we swing back to Democrats. The issue is, no matter who's in charge, it seems as though the deficit continues to expand. So I think from a kind of socio-political perspective, we are locked in that, you know, the government is doing a lot of spending and not doing a lot of cutting.
Rob, it is so wonderful to have you on. Thank you for coming and joining so early after a long weekend. Rob Casey there of Signum Global Advisors. Let's get you now some other top stories that are trending on the terminal this morning. HSBC has laid off over 24 analysts in recent days. That includes its global head of fixed income. Bloomberg sources say most of the cuts were in Europe. The move is the latest in a process of restructuring and streamlining that began when the CEO, Georges Eldury, took the helm last September. Dutch pension fund PME is issuing a blanket warning to U.S. money managers: don't cave in to pressure from the Trump administration. The $65 billion fund is concerned that the president's handling of issues like climate change and demolishing the judiciary aren't being condemned by firms. PME is the latest European pension fund to review or rescind its mandates from firms like BlackRock and State Street. Now, as we've been discussing, the European Union speeding up trade talks with the U.S. The bloc has 6 weeks before President Trump's threat of a 50% tariff comes into effect. The European Commission plans to focus its new strategy on critical sectors, as well as tariffs and non-tariff barriers. Coming up, global bond yields taking a dip, a rally underway as Japan's finance ministry said to be considering adjustments to its debt issuance. We're going to have more of that next. Stay with us on your Bloomberg Brief.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence.
the hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
You're watching Bloomberg Brief. I'm Danny Berger in New York. So long end global bonds are rallying this morning after a tough week last week. Bets have been piling up that Japan's finance ministry may be prepared to adjust debt issuance. Bloomberg's Erika Yokoyama joins us now from Tokyo for more. Erika, a very different picture than how things were last week. What's the latest reporting on what the MOF might be considering?
Right. So actually, we had quite a few developments today. And I think the one driver behind the move is, as you said, the report that the Japanese finance ministry sent out a questionnaire to bond market participants, including like primary leaders and bond buyers, about the appropriate issuance volumes. Then that market took it as a sign that the finance ministry might revise its bond issuance plan, especially it raised the speculations that the finance ministry may reduce issuance of super long bonds after the last week is 20 years bond auction saw the weakest demand in over a decade. And the timing also coincidence closely watched 40-year bond auction on Wednesday as well. And the finance ministry is set to hold a meeting with bond market participants in late June. The outcome the market is closely following. But, like in the meantime, even if the finance ministry cuts the amount of bond supply, it won't probably address the concerns about on Japan's finance health. The Japanese finance minister Kato this morning said that, at the moment, rising yields is probably not preventing from stable issuance and sales of JGB. But he also cautions that the higher yields could raise debt servicing cost for Japan and strain the national budget.
I say, Erika, can you speak to the moment of fragility right now for the JGB market when you have a BOJ that does own 50% or thereabouts of the bond market?
Mm-hmm. Yeah, that's right. And also, like Ueda, the BOJ's Governor Ueda speak today, then he just, so we will have soon the BOJ meeting in mid-June, like where the bank is also going to announce the bond purchase cut plan beyond April 2026. And, depending on the result, that will probably see another turbulence in the market as well. And speaking about the Bank of Japan's policy, and, Ueda today had a speech at the international conference, and in a rare movement, he reiterated the bank's current policy, which means the bank will continue with keep raising interest rates. And, that's highlight the importance of the banks communicating amid the growing uncertainty. And also he also noted the difficulty to measure the inflation trend at the moment, saying that Japan is now undergoing second supply shock, especially for food. So that points to some focus on the Friday data on inflation as well.
Erika, really excellent reporting this morning. We appreciate your time with us, or afternoon for you there in Tokyo. That is Bloomberg's Erika Yokoyama. Now, over in Europe, BYD has beat Tesla in sales for the first time. The Chinese EV maker notched an 169% year-over-year surge in registered vehicles in April, while Tesla's halved. Here to break down the latest European data is Bloomberg's chief European correspondent, Oliver Crook. Oliver, how much of this is about BYD's popularity versus Tesla's lack of it?
Yeah, I think it's actually the two. It's like the two elevators are crossing at this sort of very point. One going up at extreme speed, that is BYD, and Tesla going down also at just remarkable speed. So I'll just get through the numbers because this was really the standout from the European car data that we had earlier today. April sales for Tesla year on year that month down 49%, down 50%, almost halved the number of cars that they sold from a year ago. When you look at the year-to-date figure, how many cars they sold year-to-date, that is down also 40%. When you then look at the kind of market share that Tesla was enjoying in Europe, a year ago, it was 1.3% of all of the cars being sold in the European market, not just in EVs, in all of the cars across combustion engines, diesels, hybrids, it was 1.3%. Today, in the month of April, we stand at 0.7%. And as you mentioned, Danny, you can have these one-offs from time to time, but you've seen consistently here in Europe the decline of Tesla sales. There's speculation about how much of that is Elon Musk's affiliation with the Trump administration. Let's also not forget he was very sort of active in some political discourse here in Europe, in Germany, supporting the AfD. That may not be helping him at all. And as you say, BYD, on the other hand, though its Tesla sales were down 50%, up almost 170%. So you see them sort of crossing each other here in the month of April. And we should say also, Danny, BYD faces 17% tariffs in all the cars that they sell here in Europe because they're all produced over in China and sent over here. Tesla is producing many of them here. So it's kind of also a test case, interestingly, in how sort of tariffs affect auto sales across the world.
And maybe something that the EU is not too pleased about if they still have European goods, Chinese goods coming into the market, rerouted from the U.S. with more onerous tariffs. But Oliver, the economic backdrop is one where European car sales as a whole fell. Just how difficult of a moment is this for automakers in Europe?
Yeah, Danny, it's maybe not a total shock that you get a sort of people pulling back and not spending on those big ticket items the month that basically a global trade war is launched across the world. And that's exactly what we saw. Remember, Liberation Day was, April 2nd? And this is data from April. So we saw European car sales across Europe down 0.3% for the month of April. What's interesting, though, is that actually if you strip out the non-EU countries, including the UK saw sales go down by 10%. European sales just in the EU were up 1.3%. And Danny, I know this is a little bit nerdy, but this is what I enjoy looking at when we look at the actual car sales here. When you look at the engine type, what I think is very interesting is you've seen evolution in the month of April. Gas and diesel down 22%. EVs up 28%. And when you look at market share of all of the cars sold in Europe, that is slowly climbing for EVs. It's now almost 20% of all the cars sold in Europe are EVs. So you're seeing that trade sort of flip a little bit, despite the fact that there's been so much economic uncertainty, which you think might favor gas and diesel, not so in the month of April.
Yeah, maybe you'll get more news like this, though, of BYD cutting prices. That's why you see share prices off this morning, maybe trying to gain market share. Oliver, thank you so much for joining us this morning. Bloomberg's Oliver Crook there. Now, there is one big market event, perhaps the event that everyone will have its eyes on this week. It is after the bell tomorrow. NVIDIA is set to release its earnings. Shares are higher this morning by 2.7% or just thereabout. For more, let's get more with Bloomberg's Charlie Wells. Charlie, what are we expecting tomorrow?
Danny, we are expecting some positive reporting coming out of NVIDIA. So expectations are pretty high going into this much anticipated earnings report. So they are expected to post a strong quarter that ended in April. But what analysts are really looking for as well is that forward guidance. And we're expected to see revenue from NVIDIA's core chip business expand over the next 4 quarters. So that is something that investors are going to welcome if it comes out in a positive way. And of course, this is a barometer stock. This could show us what appetite has been and could be like for AI demand across the industry. It could also bode very well for the broader stock market, which of course we know has recovered significantly from those lows in April. According to BBVA strategists, there is some $7 trillion parked in cash funds. So a positive report here could help not just NVIDIA, but a lot of these other U.S. stocks that have been on something of a recovery. But still, we could see trade tensions come into play here. We know that NVIDIA has talked about a $5.5 billion write-down based on some of these export controls that the Trump administration has implemented. So positive expectations, but we are waiting for surprises as well.
Yeah, Charlie, it really feels like a lot is at stake, given to your point that NVIDIA has led the way up out of the April nadir. Charlie, thank you so much. Charlie Wells there, setting us up for tomorrow, the big event, NVIDIA earnings. Speaking of which, coming up, we're going to set you up for your trading day. We do have some data and some Fed speak on deck. We'll go through that next on your Bloomberg Brief.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Tuesday. Hopefully you've had your rest from your long weekend because we are going to kick off this short week with some data. Durable good orders, those come at 8:30 a.m. Eastern. Then we'll have Conference Board consumer confidence at 10 a.m. We'll be continuing to see the divergence between the hard and the soft data. We'll also get some Fed speak. New York Fed President John Williams will be speaking at 8 p.m. from Tokyo. Before that, though, do not miss this, our interview with Richmond Fed President Tom Barkin. That comes at 9:30 a.m. on Open Interest. The Fed speak we've been hearing has been much the same. Stay put, don't react as we wait to see how tariffs shake out. Now, some micro movers to keep track of this morning. Some stocks on the move. U.S. Steel falling this morning is down 0.5%, but that comes off the back of a 21% gain on Friday. President Trump had announced a partnership between U.S. Steel and Nippon Steel out of Japan, something that had been back and forth with both Trump and Biden previously, not wanting that deal to take place. Trump media, you can see here, up nearly 11%, planning to raise $3 billion to buy cryptocurrencies. That's the latest reporting from the FT. Finally, Salesforce looking to buy Informatica again. Those shares up 10.7%, acquiring the software company. Those talks ongoing. A quick check on your global bond market this morning because it is a rally that has been ignited by Japan. Reporting suggests that the Ministry of Finance has been out there doing surveys of market participants and is considering pulling back some of its issuance. It was this time last week that you had a 20-year Japanese bond auction that went really poorly, meant yields globally went higher. More issuance is a story throughout the globe, especially in the U.S. as the budget makes its way through D.C. Regardless, we're looking at a global bond market rally because of that. Your 10-year yield lower by just about 5 basis points. In Germany, lower by 2 basis points. All right, that's it for your Bloomberg Brief. Surveillance will take things from here. DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit. Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
We're back to tariffs on.
Of all the countries who are lining up for a deal with the United States, the European Union is going to have the hardest time.
We're also waiting for just more clarity around what the tariff policies will eventually look like.
We've seen our commentary change, not just week to week, but day to day.
Tariffs, we are still waiting to see the actual effects of tariffs, both on earnings and on the economy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into a new trading week as the president backs down.
We spoke to European Commission President von der Leyen. We had a very nice call, and I agreed to move it. I believe July 9th would be the date. That was the date she requested. She said we will rapidly get together and see if we can work something out.
Equity markets bouncing back as President Trump extends the EU's tariff deadline. The Fed firmly on the sidelines as one official accepts trade talks could take years to resolve, and bonds finding some support as Japan signals it may be prepared to tweak debt issuance. That move fueling a bond market rally worldwide.
And perhaps just emboldening people who are bullish on equities around the world, because that has been one of the big questions. At what point, given some of the exhaustion around some of the trade bingo about where we are with respect to the trade talks, where is the bond market in terms of fiscal concerns, in terms of just demand, and the fact that Japanese foreign ministers, finance ministers are going to come out and say, look, we're not going to sell as many ultra-long bonds. Right before a 40-year debt issuance has calmed a lot of people who've been very concerned about the amount of supply on the horizon.
40-year debt issuance from Japan tomorrow. Heavy slate of U.S. supply this week as well, at a time when people are concerned about fiscal deficits, not just stateside, but worldwide. Secretary Bessent on Friday, speaking to Bloomberg, pointing out the global aspect to all of this.
Just basically trying to underscore the fact this isn't just one big, beautiful bill. What did Anne-Marie call it?
1BBB.
1BBB, thank you. I need to get that, 1BBB. Other people say 1B3. It sounds like it's sort of a provision to the actual fiscal provisions. I'm just wondering, at what point this is deficit concerns, at what point is this global debt issuance, and at what point is this just simply a narrative run amok with hedge funds that are getting stopped out of basis trades and people trying to figure out exactly what narrative to put around it. There is a 7-year auction on Thursday, which is the one that I'm watching most closely, $44 billion. It's a 2-year note auction today, 5-year note tomorrow. The longer the duration, the more interesting it gets, as there's really a question about who the ultimate buyer is going to be.
So that's the debt. We need to talk about tariffs as well. Going into the long weekend, it was meant to be quiet. It wasn't quiet. The president threatened an additional 50% tariff on the EU. Backed down from that over the weekend. Also threatened Apple with a 25% tariff. Clarified that would apply to all smartphone makers making those smartphones abroad. So Tim Cook is still in the penalty box, isn't he?
Well, yes, it's an issue with iPhones. Of course, someone got into President Trump's ear and said, hey, does that give Samsung a huge advantage because everyone's just as going to get an Android since suddenly iPhones are going to be a lot more expensive? Look, the bottom line is this. First of all, we still don't know what the ultimate goal is. Why is the trade discussion more difficult between the EU and the U.S. than the U.S. and China? And then when it comes to specific tariffs on companies, how much is that actually going to incentivize them to produce in the United States? Morgan Stanley came out over the weekend and said even a 25% tariff on iPhones that are not made in the U.S. will not incentivize Apple to move production to the U.S. because it still will be more expensive and take longer to get it back here.
Equities bouncing back this morning at least. We're higher by 1.7% on the NASDAQ. On the S&P, up by 1.5. Coming up this hour, we'll catch up with Steve Sheffer of Federated as President Trump extends the EU tariff deadline. Tom Forley of Maxim Group on Trump versus Apple, and Robert Sockin of Citi seeing slowing global growth. We begin this hour with stocks higher as President Trump extends the EU's tariff deadline. Steve Sheffer of Federated Hermes sounding positive, writing this: we expect U.S. equities to outperform global markets in the second half of the year. The worst is behind us. Steve joins us now for more. Steve, good morning. Good to see you. You stayed very calm, level-headed over the last couple of months. Just remind us all, your strategic anchor, looking out 12 months, what is it at the moment?
It is companies that had every excuse to let workers go or to kind of slash their guidance. And in some cases, they pulled it, but they just suspended it. They didn't cut it. So you've got earnings growth that still looks pretty decent. You've got pro-growth tax policy coming. You've got deregulation, and you've hit the peak of tariff uncertainty. That doesn't mean that there won't be tariff uncertainty. I wasn't shocked by what the president did with the EU, right? He was, you're about halfway through that window. He wants to make sure that deals are coming across the finish line. He doesn't want folks stalling on him. So he was going to take someone out to the woodshed and remind them that, the de-escalation can go both ways. But with that being the worst of what's behind us on the tariffs, tax cuts being the discussion, deregulation being the discussion, and a labor market that has remained remarkably solid, it's hard to get overly bearish in front of that.
A lot of people are spooked, though. Spooked by the return of uncomfortable correlations, the correlations that have broken down between the equity market and the bond market. Those two asset classes still moving in lockstep. Does that concern you?
So I've been spending most of the last 2 weeks trying to understand what's going on in the bond market in particular. And, sometimes we put an easy narrative around something that's a little bit more complicated. If what was going on was just the bond vigilantes stepping in on the big, beautiful bill, then that doesn't explain what's going on with German yields. It doesn't explain what's going on with Japanese yields, which have also kind of surged. So either there's a global phenomenon or the U.S., Germany, and Japan are all facing their own issues related to the bond market. And I think once investors look at that, the U.S. will still be the best house on that street relative to Germany that's spending to buy bullets and Japan that's in kind of fiscal disarray.
Just to build, though, on what John's talking about, the one consistent theme, barring today, has been a weaker dollar. And this has come in tandem with higher yields in the United States. So even though this is a global bond market story, there is a specific U.S. aversion that is baked into that. And why does that not scare you, that we can't necessarily look at the old rules as applying in a new world?
I think you need to take a breath and wait on that. I don't think we know for certain yet. And the reason why is we still have the debt ceiling. Right, the debt ceiling's hit. We're in extraordinary measures, which means that Treasury is spending down the general account. So they're pumping dollars into the system that once you have a big, beautiful bill will have to be repaid and debt will be issued. So I think what you may see as we get this bill across the finish line is that the dollar may strengthen, but bonds might weaken a little bit. And so I think that there are some kind of technical oddities around how we're financing ourselves right now that might be distorting things with the dollar. Because it really doesn't make sense if you think about it. If you've got growth that's a little bit better in the U.S., you have a Federal Reserve that's a little bit less dovish, tariff policy that's in place, that doesn't generally argue for a weaker dollar. So I think you've got some specifics around that debt ceiling that might be muddying the waters. I think we need to see where we are in a couple of months on the dollar, and then we'll know if that's a trend or if that's just a technicality. Sometimes you just have to wait and see.
So how do you block out the noise? And I say this at a time when I read things like there's certain fear fatigue. People are exhausted of holding U.S. assets and being swung from day to day on the tariff negotiations. There's a discussion around foreign investors that have talked to a lot of fund managers who've come to this table, particularly in Europe and Canada, saying, we just can't really deal with this anymore. How do you dismiss that as being anecdotal and not necessarily wholesale and some sort of longer lasting trend?
Well, you don't dismiss, but you have to choose which sins you're willing to commit, right? If you think about it, the whole reason our industry exists is because people don't have enough money. They need it to grow. They need it to compound in the market. We can be forgiven if we keep people invested a little bit heavier going into a period of volatility, right? That's part of the game, because you know over time the market moves higher and you can invest through that, particularly if you have some cash on the sidelines that you can deploy. What you can't do, and where you really get yourself into trouble, is when you panic, move money out of the market, and then you can't get it back in, right? Those are there's this sense that not losing a dollar is somehow more noble than not making a dollar. But the probabilities are completely the opposite. We get paid to take that risk. So it's not about whether or not you take your ball and go home. It's just trying to understand which parts of the market may be a little bit more advantaged. There's always an opportunity to generate alpha. You just have to remain calm. And this idea of fear fatigue, well, we get paid a fee to not get tired. That's what our industry exists for. So you try to create a framework, you understand the probabilities, and look, if you overreacted to Trump 8 years ago, I can understand that. Today, we know the game. We understand how he does this. He's not unreasonable. Now, he may take a very, very strong and almost absurd starting position to shock the world in a negotiation, but he always generally comes back into something that markets can deal with. Now, whether you think that's the right thing to do or not, that's a personal problem. From a money management perspective, you remain calm and you invest for the end point.
Have you increased your equity exposure in the last month or so? And if so, where have you done that?
Yeah, we did. So we put up a picture of Ulysses sailing through the straits strapped to the mast at the beginning of the year. And our goal was to not get caught up in the volatility and add to the equity weight. And the opportunity that was the most compelling for us in the sell-off was in large cap growth. I mean, you saw, you had the Mag 7 trading at 2, 3, 4-year PE lows. They were 6 multiple points below their 3-year average, down 20%. Look, these are companies that navigated an almost collapse of the financial system in 2009 and us turning off the entire global economy with a light switch 5 years ago. I think they can handle a sales tax.
Have you been buying 30-year treasuries?
No, we've been more neutral in duration, although I will say that, honestly, because what we found is where you'd want to take risk in the bond market, if you're going out in terms of credit, the spreads are so tight, we'd rather take the equity risk. And so, you know, I'd much rather buy or had at the beginning of the year, solid dividend-paying equities than buying high-yield treasuries at 300 basis point spreads. So it's really been, we've been underweight bonds at the expense of equities through the year by about 4 to 5%. I do think that the negativity around the bond market is starting to get to a place where you got to take the other side of it. I really do. I think whether it is the big, beautiful bill not being quite as deficit enhancing as people anticipated, and I think when you take into account tariff revenue, it's not quite the deficit monster people think. I think when you see central banks and foreign governments starting to step in bond markets, deregulation, you've heard Bessent talk about maybe suspending the SLR. I think we're getting to a point where you're going to want to take the other side of the bond market and be contrarian. We haven't pulled the trigger on that yet.
Steve, when you do, drop by.
Will do.
It's good to see you. As always, Steve Chevron there at Federated Hermes. This morning, the bond market rallying, yields lower on a 10-year by 5 basis points. Your yield, 4.46. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Anand. Hey, Yahara.
Good morning, John. The European Union has agreed to speed up trade talks with the U.S., this coming just days after President Trump criticized the group for slow-playing negotiations and taking advantage of the U.S. A European Commission spokeswoman says there is new impetus for talks after Trump extended the deadline for 50% tariffs on the EU. Meanwhile, President Trump is growing more frustrated with Russian President Vladimir Putin. The president spoke on Sunday saying he's absolutely considering sanctions. It came before Russia launched its largest drone barrage yet against Ukraine. The Kremlin is dismissing the president's comments as an emotional reaction. And HSBC dismissed more than 24 analysts, and those affected include Stephen Major, a frequent guest on our network. That's according to sources telling us here at Bloomberg it's part of a sweeping restructuring of its investment banking business. The restructuring, led by CEO George Elhedery, is expected to lead to $1.8 billion in charges over the next 2 years. That's your Bloomberg Brief. John?
Yahara, thank you. Steve Major, absolute legend, and any bank would be very lucky to employ him. Up next on the programme, the EU comes to the table.
You spoke to European Commission President von der Leyen. Did you discuss the 50% tariff? She just called me, as you know, and she asked for an extension on the June 1st date. And she said she wants to get down to serious negotiation.
Up next on the programme, Terry Haynes of Pangaea Policy, live from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Getting back to work after the long weekend, and equity futures are bouncing back by 1.5% on the S&P 500. On the Nasdaq, up by 1.7%. One single name of the pre-market, Apple. Apple lower for 8 consecutive days, the longest streak going back to 2022. And over that period, down by more than 8%. This morning, the bounce back looks like this. We're up by 1.9%. This is one to watch, with additional tariffs in focus. I want to turn to the bond market as well. 2-year, 10-year and 30-year. Some support coming into fixed income. Treasury yields are lower. We're down by 5 basis points on 10s, down by 7 on 30s. Lisa, just on the sidelines, the conversation around Japan and the Ministry of Finance maybe stepping in and tweaking bond issuance.
Maybe reducing some of their very long bond issuance at a time where you've seen the sell-off really permeate through that region. So is the Japanese bond market now dictating where the U.S. bond market is going? This is something that we just heard Steve Chiavarone speak about. It is a more complicated story than just the one big beautiful bill in the U.S. This is a global story, and it's something that people still are trying to figure out.
A better tone in both bonds and stocks, at least so far this morning. Under surveillance this morning, the EU comes to the table.
You spoke to European Commission President von der Leyen. Did you discuss the 50% tariff? She just called me, as you know, and she asked for an extension on the June 1st date. And she said she wants to get down to serious negotiation. We had a very nice call, and I agreed to move it. I agreed to do that, and that she said we will rapidly get together and see if we can work something out.
So here's the latest this morning. President Trump extending the EU's tariff deadline to July 9th. Sources telling us here at Bloomberg the European Commission is coming to the table, focusing on critical sectors including autos, chips and more. Joining us now, the team coverage with Bloomberg's Tyler Kendall in Washington and Ollie Crook in Berlin. Ollie, walk us through the ask. Do we understand the ask from the US of the Europeans?
I think not yet, and I think that's the frustration from the European side, and of course the frustration from the U.S. side is that there's nothing concrete enough for them to really sink their teeth in at this point, and that we're still deep into the weeds. The message from the European Commission over the last couple of days has been, listen, we're now on the fast track with negotiations with the United States, trying to breathe some momentum and a bit of positivity into these talks that really, frankly, has not been there so far. So what we understand now in terms of the focus of the EU Commission is they're going to focus on negotiating first the big five. That is going to be steel and aluminum, cars, pharmaceuticals, semiconductors, and planes. There is still the issue of the non-tariff barriers, right? This is part of the complexity of negotiating on behalf of 27 member states. Some of the issues the Trump administration wants to deal with are under domestic regulatory or tax sort of considerations, and the EU does not have authority to negotiate on. And they want to also fold in some of the regulatory barriers with a broader simplification push that the EU has been pushing for the last couple of months in their new commission. But when I hear that, John, I get a little bit worried because we only got about 6 weeks worth of runway here, and I know how much time it takes to get some of these initiatives through the EU and how difficult they are to understand, and that is not what the Trump administration is after.
Tyler, July 9th, how difficult is it going to be to get something over the line?
Well, we also have to keep in mind that that's the same date that these other countries are also up against when it comes to negotiating the so-called reciprocal tariffs. And while, of course, this is a positive step to allow some more runway, there's still a long way to go here, as you were hearing Oliver outline. At this point, there really has been frustration from the European Union that it's unclear what the U.S. needs to see in order for there to be a deal. But on the other side of it, we've really heard White House officials repeatedly tell us that their point of frustration is that it's been hard to build consensus since they are negotiating as a bloc, and it's hard to get all 27 member states to ultimately agree. We're going to be watching really closely, of course, some areas here, of course, those critical sectors that have been subject to Section 232 investigations, but also how the EU perhaps pledges to boost imports from these areas. Also, U.S. LNG is an important one to watch. But ultimately, John, we're going to have to see how this shakes out, because there's a lot of difficulty here when we know that the White House is prioritizing those non-tariff barriers, which at this point, a lot of it seems to be a red line.
Tyler, Ollie, to the both of you, thank you from Washington, D.C. and from Berlin, respectively. To extend the conversation, Terry Haynes of Pangea Policy. Terry, welcome back to the program, sir. Why have the Europeans found themselves in such a difficult spot?
There's a couple of reasons, John. One is just the nature of their federation. Those of you who are American history buffs consider the EU much closer to the Articles of Confederation, where, as one of your correspondents said, every major decision has to go back and be played through each of the 27 member countries. So, the structure's not great. There's also tensions between the European Commission, kind of the Supremos in the Berlaymont in Brussels, and the 27 member nations. So that makes for a very complicated group. And just about every other negotiation that the United States is pursuing, whether it be with the UK, whether it be with India, whether it be with Japan, let's say, or even China, you know who you're dealing with, and you know what kind of response you're going to get. So this is uniquely difficult.
Terry, do we have a better understanding after this weekend of what the ultimate goals are with these negotiations, what the desired outcome looks like?
On the EU, I don't think we do, but my view of this is that, Lutnick and his people at Commerce had gone out even before the April 2nd date and had given various countries wish lists of things that they wanted. So whether or not somebody in the Berlaymont got a list, I think, is beside the point, because a lot of the member countries did, almost certainly. Germany did, France did. I mean, the main countries in the European Union know what the United States ask is generally, but the EU as a whole has to get down to it. And the scheme of the EC is always to delay, as any British Prime Minister in the last 10 years well knows.
Do we get a sense that the one big beautiful bill and the fact that it did pass in Congress gave ammunition to the administration to focus back on trade, and that we can expect a lot more headlines to be made about trade over the next few weeks?
Well, I think they've been doing both, but I think there's probably a lot more headlines on trade to be had, simply because, the Senate negotiations on the tax bill are kind of, much more in the can. They're much more baked. Everybody knows what they are. But the expectation is that over the next month, you're going to see a lot of those major deals. And, you know, one of those is India, where the Indians have said quite publicly that they expect a deal to be done in the first phase by July 9th, with 18 more sectors by October. You know, whether or not the United States agrees with all those, that framework or not is another thing. I doubt that they hugely disagree with it, but there's a lot of optimism coming from India. And, you know, I've always thought that's exactly how you have to read what's going on with Apple, is through the Indian trade negotiations, not as anything that's been going on with Apple.
Terry, just build on that. What do you mean by that?
What I mean is that people tend to look at, you know, look, I'm not an Apple analyst, okay? I'm not saying buy or sell Apple. What I am saying is that the markets tend to look at Apple or, you know, Tesla or, you know, whatever, in a very siloed sort of way. What's going on? Trump's mad at them. Trump loves them, whatever it is. What's going on here, almost certainly, I think, and this is instinct, but you know, there's U.S.-India negotiations way down the track. India is a major beneficiary of offshoring from China, in this case, iPhones to India. Trump likes to shake up negotiations. It's a standard negotiating tactic, not just for him. And the shakeup, part of the shakeup is, well, I'll introduce something new into the mix. Let me remind you, India, that you're the beneficiaries of United States policies here. So I'm going to put that one on the table too, and then we'll figure out where our negotiations go from there. So, you know, I'm just looking at Apple as a bargaining chip in the larger trade negotiations with India, frankly.
Terry, there's also a foreign policy wrinkle in the mix as well, the threat of secondary sanctions against Russia and what that could mean for India, for China. How's that going to play out in the next few weeks and months?
You know, I think it matters. It matters in the U.S.-EU negotiations too, John. It matters greatly, because what you're going to have is a situation where, you know, this is a classic watch what they do, watch not what they say. The European Union heaped a lot of scorn on the Trump administration, and Trump personally, and Vice President Vance personally, for their remarks over the winter and their going-in position on Ukraine. But now we're in a situation where the geopolitics are different, and the United States, as well as the European Union, are taking the shackles off the use of weapons that are provided to Ukraine by all of those countries. You know, what you're going to see in the successive weeks, I think, is a geopolitical ramp up that's designed not just to put more pressure on Russia, but more importantly, put more geopolitical pressure on China to get their client state Russia to the table. So this is yet another example where the geopolitics is driving the economic policy.
Terry, it's good to hear from you, as always, smart. Terry Haynes there of Pangea Policy. A geopolitical dimension to the trade talks make this even more complex than it already is.
Especially as we heard President Trump talk about the possibility of secondary sanctions over the weekend in response to some of the attacks, additional attacks on Ukraine. If everything's a pawn, there's this question of what the ultimate game is, and I think that's what everyone's trying to get their head around.
Equity futures doing better this morning. If you are just joining us, welcome to the program, higher by 1.5%. Up next, we'll catch up with Tom Forty of Maxim Group on President Trump versus Apple.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that not enough guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Four-day slide on the S&P 500, looking to erase that this morning. Equity futures positive by 1.6% on the S&P, up by close to 1.8% on the Nasdaq 100. That's the index level price action. Let's get you some single names. 3 hours away from the opening bell with your morning movers. It's Danny Berger. Hey, Danny.
Hey, John. DJT, Donald Trump's media group, on the upside this morning, up nearly 10% in the pre-market. There's some FT reporting yesterday that they're looking to raise $3 billion in order to buy cryptocurrencies. This all ahead of a big conference in Las Vegas where Don Jr., Eric Trump, and David Sachs, the White House crypto czar, will all be speaking at it. So the thought is, if you're going to make an announcement to this caliber, why not do it in Vegas for that conference? So those shares moving higher. We also have a little bit of deal news, some exclusive reporting from the deal team over at Bloomberg. It looks like Salesforce might be buying Informatica. At least it is examining this again. This is a revival of an old deal. They had looked at doing it last year, the software company. Those talks fell through. Well, they're giving it another look. Informatica up 8.5%, more than that. It's a huge rally because we also learned this on Friday where shares gained 17%, so we're really adding some weight to that. Finally, wrapping things up with Stellantis, also moving to the upside, just showing the extent to which a lot of stocks this morning are moving on that trade tariff, 50% on the EU pause that we got over the weekend. Stellantis up 7.4% for its U.S. ADR, even despite the fact we got some European auto sales. They looked pretty weak. Stellantis fell about 0.5% year over year, but even so, that story injecting some optimism into shares this morning, John.
Danny, thank you. Danny Berger there on some of the movers out there for you. More from Danny in the next hour. On our radar this morning, our top story, the EU fast-tracking trade talks with the US just 6 weeks before President Trump's 50% tariffs would go into effect. The European Commission focusing on critical sectors including autos, semiconductors and pharma.
The response, I think, is really important, and Danny just highlighted it, that the bounce back has been much more significant than the sell-off was on Friday to the announcement of a potential 50% tariff on all European goods, which just highlights that people kind of have understood the game. To quote Steve Chivarone, they don't take it that seriously, the idea of a 50% tariff on the European Union, because that would, by all economists' accounts over the weekend, would have sent the region into recession. But the declines were some 1% on the DAX, 1.7% on the stocks 50. So you start looking at these kind of declines, and then you start looking at the rebounds this morning. I think that you get a sense of where people's minds are.
We've got these two self-imposed deadlines now, July 4th for the tax bill, July 9th for the conversations around tariffs. What are we going to look like July 10th? By the time we get to the start of July, after that first week, second week, what does the world look like? What does the policy mix look like? And Steve Chivarone making the point that after we get over this hump, by the time you get to the end of the year, the policy mix will still be favorable, and that's why it's long equities.
I just think that the hump gets moved. I don't understand how we get some sort of comprehensive trade deal by July 9th from all accounts, given the fact that you're talking about a lot of non-tariff barriers, whether it's the VAT tax, whether it's some of the regulatory overhang in Europe. Imagine changing all of the regulatory frameworks in Europe over the next 45 days. Does that seem feasible to anybody? So there's this real question mark of what it will take to push that hump later in the year so we can really be talking about that.
And the Chinese issues are going to linger. Take a listen to this. The Chinese President Xi Jinping is working on a new version of his Made in China China 2025 campaign. Sources telling us here at Bloomberg that China will stick with plans to prioritize chip production despite criticism from both the US and from Europe too.
And this comes in tandem with a lack of initiatives when it comes to trying to really boost domestic consumption. So this raises a question. Will China commit to having its residents spend more money, or is it going to double down on what it always has doubled down, which is manufacturing? And what you have seen is even though exports from China into the U.S. have gone down a lot since some of these trade issues really percolated to the surface, you've seen overall exports from China to the rest of the world surge to new record highs. So this really raises this question of, are they going to just try to find new lands to sell their goods to and get them even cheaper, as you see things like places like BYD cut prices to new lows to try to get that market share?
Or just sell even more to the Europeans, which goes back to Europe, and I think this is the important question. What is the ask of the EU? Is it to drop tariffs on the US or raise tariffs on China? Are they going to be part of the negotiations, that dimension of this story, part of the negotiations in the weeks to come?
This is going to be the ultimate question. When we first set out with this agenda, we thought, okay, this is to try to bring some sort of coalition together to counter China and the threat of overproduction and sort of exporting cheap goods. It's hard to see how they're making strides toward that. Maybe that is part of the goal, but I think a lot of people are wondering how much that's part of the conversation right now between the U.S. and the EU.
So we've taken down the temperature on trade just a little bit after we turned it up on Friday, going into the weekend, and equities rally. Bond markets are rallying too. Japanese bonds rallying hard on signs the finance ministry may be prepared to adjust debt issuance following a market row. The move pushing Japanese bond yields down and weakening the yen. We're seeing an aggressive rally at the long end of the curve, not just in Japan, but elsewhere too.
Yeah, and this really highlights the question, as Scott Besson addressed, which is this is a global move. How much of this really stems from the United States and the loss of exceptionalism and concerns about the deficit, and how much has to do globally with an increase in fiscal spending and some sort of other shift, given the fact that you see inflation. You also had the Bank of Japan talk about possibly raising rates more quickly. So this raises this issue at a broader level. If this isn't just a U.S. phenomenon, what is this in the bond market? Is this a more persistent, sustained level of rates that's going to be higher? Is this a narrative looking for a home and finding it in the bond market? Or is this something that is a distortion that a lot of people will look to buy?
Japan is a big piece of the bond market puzzle, particularly this year. It always is. Yields are lower across the curve. Stateside on a 10-year this morning, we're down 4 basis points to about 4.47. Let's turn back to trade. President Trump threatening Apple with 25% tariffs unless it manufactures iPhones in the US. Tom Forty of Maxim Group writing, in the event that leads to iPhones made in the US, we believe Apple would have to implement heavy automation to make the cost more competitive. Tom joins us now for more. Tom, welcome back to the program, sir. Before we get into the operational issues, I just want to talk about the reputational problems. Tom, why do we see this issue with Apple in a way that we didn't in the first term? Is the president's problem with India, with Apple, or with Tim Cook?
Yeah, so I think clearly the administration is trying to accomplish 3 goals. Reduce the trade deficit, reduce the budget deficit, bring some jobs back to the U.S. So I think that's really the focus of the second Trump term. Apple's caught in the middle. They're caught in the middle between the U.S. and China. They're caught in the middle between the U.S. and India. Their global supply chain right now is putting them in a tough situation.
At this point, Tom, does it seem likely that they're going to raise prices regardless, just to insulate themselves from that uncertainty?
Yeah, so when you look at the situation with tariffs, we're trying to determine 3 things. To what extent can a company lean on its suppliers to absorb the cost? To what extent does the company need to absorb the incremental cost? For Apple, they pointed out that $900 million figure for the June quarter. And then to what extent can the company raise prices? The good news is that we believe that Apple can raise prices to offset this tariff increase. Historically, Apple's strength is at the high end of the consumer electronics market, and I think they also benefit from the carriers who are subsidizing their products very significantly, especially the iPhone.
How much does that give them a competitive disadvantage against, say, Samsung at a time, especially when AI is becoming increasingly part of the conversation? If they're being forced to raise prices at a time when other areas are looking to cut and possibly offer better technologies?
Yeah, so I have a hard time believing that Apple is in a silo and Apple would be the only one that has to raise prices. You brought up the point of artificial intelligence. That has been a black eye for Apple, especially their ability to use artificial intelligence for a much-needed upgrade for Siri. So I don't think Apple would be alone in raising price. So I'm less concerned about a situation where Apple's raising prices and Samsung isn't, and more concerned that Apple doesn't find a way to implement their artificial intelligence-related upgrades to their ecosystem to draw on consumers in that regard.
Apple's a fantastic example, Tom, and I wonder if we can zoom out to understand Apple and how they're responding to some of these threats as a way to understand what large tech companies could do. Are they going to start investing in automation in the United States, even on the margins, even if they aren't going to bring production wholesale back to the United States? Do you see any investment coming on the backs of some of these threats?
Yeah, so at the minimum, we know that on the last earnings call, they identified 9 or 10 states where they're going to bring jobs. In many instances, having iPhone components made at those locations. But I do think when we talk about a U.S. assembled, because that's essentially what we're talking about, assembled iPhone, there's going to have to be a heavy level of automation. The good news for Apple is I think Tesla's a good poster child of this when you think about their regionalized manufacturing efforts in the U.S., in Europe, in China, and their emphasis of automation when we think of Optimus. So clearly, I think that if we see that U.S. assembled iPhone, there's going to have to be a fair level of automation to make it cost competitive with those across the globe.
Tom, as you know, that can take a while. So in between, the diplomat, Tim Cook, has got to do something. What can he do? What kind of investment commitments do you think he can make at the moment to make this all go away?
Yeah, so absolutely. So I do think, Jonathan, that what we might see here is an increase on that $500 billion commitment. What basically the Trump administration is offering Apple is a short-term reprieve on tariffs as it pertains to smartphones and computers. And what the Trump administration is offering all companies, including Apple, is lower corporate tax rates. So I think that a higher commitment beyond the $500 billion might be enough to seal the negotiation at this point in time.
Tom, let's finish on the name. 8-day losing run. Haven't seen a streak like this going back to 2022. Tom, what are you telling clients at the moment about how to value this company given the headwinds it currently faces and the fact that its core hardware, core piece of hardware, went ex-growth a number of years ago?
Yeah, so you look at our $201 price target and our hold rating, we've got about a 28 times multiple on out-year earnings. I think the challenge is that even when things were going well for Apple, you were looking at a high 20s multiple and mid-single-digit earnings growth. An argument can be made that it deserves that high multiple given all the free cash flow it generates and a large portion of that free cash flow that goes back to buying back shares, paying dividends, things of that nature. I do worry on a near-term basis over the next 12 months that all this China risk isn't necessarily fully priced into the stock yet.
In what way should it be priced in, Tom?
I mean, a lower multiple. So I think at this point in time, an argument can be made. It certainly doesn't deserve a 30 times multiple, which is where it's traded at oftentimes over the last 12 months.
Tom Fordy of Maxim Group. Tom, thank you, sir. Appreciate it. The CEO, no longer the diplomat, Tim Cook, not in a great place in the president's second term compared to where he was in the first term.
If he's being used as a pawn between India and the U.S. trade negotiations, very difficult to see what he can actually do. Tom Fordy there was talking about potentially increasing that $500 million investment and possibly getting something more from that. But then how does that work with being used as a pawn? He doesn't really seem to have a good winning strategy other than just raising prices, especially phones that cost already about $1,500.
Which is something KeyBank and the analysts over there, the team over there, are expecting later on this year, potentially. Apple in the pre-market is bouncing back. It's higher by about 1.9% in early trading. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. German Chancellor Friedrich Merz says Ukraine has been given permission to use weapons given by its allies to strike deep inside Russia. Ukrainian President Volodymyr Zelensky has long pleaded for this authorization, which has gained added traction amid Russia's fresh set of attacks and Putin's reluctance to engage in serious talks. Meanwhile, Salesforce is closing in on an $8 billion deal to acquire Informatica. The Wall Street Journal reporting Salesforce is expected to pay $25 per share for the data management software company. And dozens of people were hospitalized in Liverpool after a car collided with pedestrians during a parade honoring the city's football team. A 53-year-old British man from the area was arrested, with police saying they believe him to be the driver of the car and that he acted alone. The incident is not being treated as terrorism. That's your Bloomberg brief. John?
Yahara, thank you. We'll be monitoring that story and bringing you updates as we have them. Up next on the program, waiting for September.
There's no question that the shock of tariffs are stagflationary. Is it going to be clear enough by September? I'm just not sure right now. Ultimately, we'll have to see what the data says.
Fed officials firmly on the sidelines. Up next on the program, Robert Sokkin of Citi from New York City. You're watching Bloomberg TV.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more.